Episodes on now, so I thought it'd be a good point to check in with you and give another update on how I'm tracking. So Zach joins me again for this week's episode. Just a quick intro. Zach originally appeared on the podcast for episode 11, where he shared a great deal of insight into how he uses VWAP, being the volume weighted average price, at the core of his trading strategy. He's also become a very good friend of mine since we first met at the beginning of this year, 2015, and has personally helped me a great deal with my own trading. During this episode, you'll find the first part is mostly Zach asking questions for me to answer. Then we switch it up, and the later part is me asking questions for Zach to answer. Just to add on that, pretty much every question asked during this episode has been crowdsourced. So if you contributed a question last week, then there's a very good chance you'll hear it asked at some point during this episode. As you may have already seen, this is a pretty extensive episode. It runs much longer than normal. So if you make it all the way to the end, then props to you. And I totally understand if you need to break this up and don't listen to it all at once. Two things just quickly before we get into it. I know we have a lot to get through. Zach is again offering a free 30-minute one-on-one coaching session to any trader listening who is, of course, serious and feels as though they could really do with some help. A very generous offer, and if you'd like to take him up on it, then send Zach an email. His address is tradingcoachz@gmail.com. And the second point I'd like to add is if you have any questions or comments for Zach or myself, just go to chatwithtraders.com/50, scroll to the bottom of the page and drop a line in the comments area. Both Zach and I will be keeping a close eye on this to respond to anyone and look forward to interacting with you there. So that's chatwithtraders.com/50. All right, let's get into it. I'm your host, Aaron Fifield. As you already know, this is the Chat with Traders podcast, and please welcome my guest for episode 50, Zach Hurwitz. All right, and we're recording. Zach, what's going on, man? How are you?
Doing good, Aaron. Thanks so much for having me back on the podcast, and congratulations on 50 awesome episodes. I should say 49, a little anticipatory that this one's going to be so good.
Yeah, I mean, we've just reached 500,000 downloads, 500,000 downloads, so it's a pretty cool milestone to hit. And I mean, thank you to everyone listening. I just want to really put that out there because I, obviously appreciate the support and everyone listening in. Yeah, it's a cool milestone to hit.
I love how nonchalant you are that you're like, yeah, 500,000 downloads. It's pretty cool, guys. I have 600 Twitter followers, Aaron. Come on, let's talk. 500,000 is a giant number. You should be really excited about that. I know everybody is thrilled for you, not only the success, but the fact that you've got, where do you go from here? I know we're going to talk about that in a little bit, but in 50 episodes, you've already covered so much ground.
Yeah. I've got plenty great guests lined up, especially in the early part of 2016 already. So, we still got a long way to go. But, fill us in on what's been happening since episode 25 when you were last on the podcast.
Well, I started using this new website called twitter.com. I don't know if you've heard of it. It's pretty big these days. The kids are using it. And just developing my own site, thevwap.com. And go check it out. We're going to be launching in 2016 with a recorded course and plenty of other great VWAP material, as you might imagine. Just keeping busy. Believe it or not, I'm still receiving like 5 to 10 emails a week from traders from the episode that I did with you back in March of this year. So it's been 9 months. I still get 5 to 10 emails a week. I'm thrilled, though. I'm glad that what I say has resonated with so many people. So I'm sure you feel the same way, right?
Yeah, that's awesome. That's really good to hear. So, episode 50, last time we spoke was episode 25, and I sort of gave a bit of an update on where I was at with my trading, some of the goals I was hoping to achieve, and just some of the things I've been learning. And we also, asked you a few questions as well. So this time for episode 50, we're going to do something similar, but we've crowdsourced a lot of the questions. So I sent an email out earlier this week and I've had an overwhelming response of questions. Hopefully I can answer the questions you guys have been asking. So Zach, I know you've got a bunch of questions that are aimed at me over there. What's first on the list?
Yeah, well, the question on everyone's mind since episode 25 last time you were aiming to have an automated strategy within 6 months. Have you reached this goal?
The short answer is no, not quite. I have covered steady ground on it. I'm not at a level where I'm trading an algorithm. It's not automated. I don't have a profitable strategy ready to deploy into the market. I'm still quite a way away from that stage. But in saying that, I mean, I have really been digging into the code over the last 6 months and just really building my knowledge up on how to program. I have created a few basic algorithms that do work, and they have all the functionality there. They're not algorithms that would be worthwhile trading though, but they're a good starting point, a good base to kind of build from. Yeah, so that's the short answer.
Yeah. I mean, I'm sure, like you're saying, you've learned so much from just creating any system. It doesn't even have to be anything close to your actual thesis about how to trade, but learning even a moving average cross or breakout to new highs. Some basic strategy will teach you so much about coding and identifying a lot of these systems. I mean, what do you think has caused you to, like, not quite reach the goal that you set? Was there anything that held you back?
Yeah, I mean, probably was slightly naive in thinking I could learn how to program and then use that programming knowledge to code or script and a profitable strategy.
Are you separating there? You're separating that, like, learning the trading and learning the coding are two totally different, like, paths of learning.
Essentially, yeah, because I mean, to go in the algorithmic direction, you do need to have a pretty solid understanding of how to program. You also need to then identify a strategy that can be programmed, because the strategy or the type of setups that I was trading kind of earlier this year and later last year are quite difficult to program. I mean, that's one of the things I learned as well, was because those types of strategies were very visual, as things such as like horizontal support and resistance are very hard. Well, for me at this level, are quite hard to
Identify and track a prior support level or prior swing low or swing high.
Yeah,
Yeah.
definitely. So I mean, one of the things I have learned is that there's quite a big difference in the type of strategies that can be used discretionarily and those that can be used in a quantitative, more systematic way. So, I mean, that was probably one of the things, is just a bit naive on how steep the actual learning curve was. I also questioned myself quite a lot over the last 6 months about whether I was doing the right thing, whether learning, Python scripting language was the right direction. But I know there's easier ways to achieve the goal of, systematic automated trading. For some reason, they just didn't really appeal to me, and Python really stood out, and I just felt like it was a more valuable skill to have in the long run. I mean, some of the other things I was considering was, obviously going back to, languages like ThinkScript, or maybe I should have been using something like TradeStation. They've also got their easy language. The cool thing about Python is it's open sourced, so you can use it on any platform. You're not limited in that regards. And I guess probably the other reason, which I found a bit challenging, was it kind of time constraints. Because I mean, I'm not trading full time, which means I need to try and find an income in other areas, which means that I've still been doing the occasional graphical web design job. As much as I hate it, it's money coming in. So, I've had that. I've been running the podcast. You've also got your personal life away from the computer as well.
You have a personal life?
Yeah, there's a small one
Oh
there.
my God, I missed out. I forgot. Yeah. I was going to give you a hard time. I was going to say, what the hell else have you been doing with your time, Aaron? It's not like you have a podcast or anything to run.
Yeah, so one of the things I've I think it's good that I can identify what's been holding me back. Well, not holding me back, but what's slowed my progress a little bit. I don't know if that's even the right word, but
You remember when we talked about this, I think a couple months back when you were deciding between the languages, you made a really good point about backtestability, that whatever strategy you're trying to code or identify or eventually employ or deploy is our favorite word for algo trading, right? Deploy it. You had said Python and I know TradeScript, this is one advantage they both have, TradeStation's easy language versus ThinkScript. One advantage that Python and TradeStation have over ThinkScript is that they're backtestable. They're easy to kind of vet the strategy on the fly. Did that factor into the kind of delay?
yeah, absolutely. I mean, because I know it would have been easier for me to maybe use something like TradeStation, but I think I try to look at things in a very big picture. I think I might have mentioned this last time. And I think in the long run, knowing an open sourced programming language that's a lot more versatile, has pretty much the only limitation to it is your own creativity, is going to be more valuable in the long run. Yeah, and I mean, one of the things, I mean, I was coding earlier today for a few hours before we got on the call here, and I was, just running a few back tests, and you could just see you would, obviously hit the back test button, and it would draw out the equity curve, over the period that you were back testing a strategy. And some of these strategies, they just, they spike up at the beginning, and then that for the next, let's say 3 years that you're back testing, it's just going down, 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 just keeps going down. And it's just really cool to see that. And I think that is quite powerful because, what I was back testing was a strategy that some people will be trading that, or some people will be trading something very similar, but they've never back tested it. They're kind of trading blind in some regards. So it was just, I think there's a lot of power in being able to see just how that performed in the past. Even if it's not going to perform exactly like that in the future, right then and there that that's not something you're going to continue to trade.
It's like there's three levels of awareness. There's the people who are like not aware at all of anything resembling an equity curve for their strategy. There's people who have an idea but haven't gotten the equity curve yet. And then there's people who have the equity curve. So being able to see it, I think that's a great point, that there are people putting this into practice who don't know their numbers, but you're seeing almost like the fabric of the fates. You're seeing someone's life, that they don't know that they're about to undertake, right? Now, obviously, not every trading record with a given strategy is going to be the same. You have to Monte Carlo it to see exactly how many different permutations there are and how many different potential paths with the same trading report. Have you gotten into Monte Carlo backtesting by chance, for anyone who's listening who might be interested in Aaron's experience with Monte Carlo?
Very little. Very little is the short answer. That's definitely something I'm keen to explore, in the months going forward. I have done some basic Monte Carlo work in Python, mainly following tutorials. But, that's all been really helpful as well. That's definitely something I'm going to need to learn and dig into a lot more going forward, though.
For anyone who's wondering, I'll give a super cursory explanation of Monte Carlo. Imagine you had 100 trades, but you took them in a different order. So they all had the same outcome of the last 100 trades of yours that we're examining, but they came in a different order. What if all your winners came at the beginning, or all your winners came at the end? That would dramatically affect how your sort of net output at the very end of the 100 trades would come out to. Monte Carlo scrambles those trades and their order hundreds, thousands, tens of thousands of times and gives you a kind of best and worst case scenario, so to speak.
Yeah, and I think if anyone actually wants to look at that a little bit more, Phil Lawrence.
Exactly, link them to Phil's article, yeah.
Yeah, so I'll put a link to that in the show notes. That article, I mean, many of you have probably already read it. It's called The Numbers You Wish You Knew About Your Trading. He's got a great explanation that actually hits on Monte Carlo in that, as well as some good visualizations and screenshots of tests he's done. So, that'll go into that a little bit more. So, what other questions have we got on the list there, Zach?
Sure. Well, one question that I think a lot of traders would want to hear about from you is like, by nature, what type of trader are you? And,
Yes.
yeah, go ahead.
Yeah. So the type of trading that I'm naturally attracted to, probably just because that's what I was first introduced to when I got into trading, is swing trading. So and when I say swing trading, holding positions anywhere from a couple days to a couple weeks. I don't really like to hold anything beyond that. Talking like, holding for a couple months, that can really, a day trader, that doesn't really appeal to me too much. Although in saying that, my goal with moving in the algorithmic trading direction is to have strategies that operate on a number of time frames, and one of those time frames would most definitely be intraday strategies. So I'd like to layer it with a couple intraday strategies, a couple swing trading strategies, and then maybe even a couple longer term strategies as well. And I mean, that's something I picked up from speaking with Kevin Davey. I think that was episode 39. It was around about that time. And he said that having, like a basket of strategies actually helps you smooth out your equity curve over time as well. So, that was a good takeaway from that interview.
Well, it's a good point that he's making, that you can't build one strategy to solve every type of market. You need a grouping or kind of cadre and an armory of strategies to apply to a variety of markets. You don't have to apply to every single one. You don't have to have something in your basket for each type of market. You just try and cover as much ground as you can and produce a smoother equity curve, as you're saying.
Yeah, 100%.
I think you're also being a little bit modest, not to give too much away to the listeners, but you and I have done a little bit of day trading together, actually. And Aaron's being modest. He's a pretty talented intraday trader, but what's I think really cool is that you're picking a strategy that fits with your style of kind of your personality, right? You know that you don't want to be impulsive, staring at the screen for 8 hours a day. It's not going to fit with all your other obligations. You need something that's automated, more even keeled, maybe a longer term strategy, but not quite investing.
Exactly. Yeah. Yeah. I think you hit the nail on the head.
Sure. Yeah. How do you feel about your progress to date, even though you haven't hit the target you're aiming for? Are you discouraged at all by this?
Well, there's definitely been times over the last 6 months where I have been pretty disappointed, but then I sort of stop and think, right? So I think back to where I very first began. So when I very first decided I was going to start learning how to code, right? I didn't even know what an integer was. I didn't know what a float was. I didn't know what a function, a method. I didn't have any idea. And I look at what I'm doing, what I've been doing earlier today before we jumped on this call, and I've, right now at this point, I've been able to code an algorithm from scratch. Admittedly, it is fairly basic, but it works, and it's a good starting base, something to build from there. So yeah, I've definitely been disappointed with my progress at times, but I think everything always takes a lot longer than you anticipate that it will. Plus, the knowledge that I've acquired from doing 25 interviews since we last spoke, or spoke and recorded it, is huge. It definitely helps me, whether I trade like those traders or or not. There's still something I can take away from everyone, and we're probably going to get into that a little bit more as we go. But yeah, overall, I think I'm okay with where I'm at. It would be nice, I'm not really actively trading at the moment. Instead of spending, a couple hours after the market closes each day looking at charts and that sort of thing, I find myself still looking at charts, at least a few times a week, but I'm usually spending a good few hours each night learning how to code and program and that sort of thing. So it's a little bit different to, I think, most people that I speak to during the week, like people who email me who listen to the show. I think it's a little bit of a different path than what many of those what many other people decide to take. And yeah, I mean, obviously, I just hope I'm doing the right thing.
You realize how this relates to like what other traders experience in their own trading career. They expect it to be, I mean, they set the bar so high, right? They say, all right, well, in 6 months, I'm going to have $1 million acquired from my, proprietary strategy of so and so and so and so that I'm going to enact 8 hours a day with no failure, with absolute consistency and total risk management. And on the second day, they screw something up. They go, oh my God, this is way harder than I thought. We experience failure so frequently in trading because we set the bar for success so ungodly high, right? I mean, look, I didn't want to you know, bark at you on the last interview and say 6 months. There's no way you're going to get a strategy up and running in 6 months. I wanted to be encouraging, but look, that's an aggressive goal for anyone, even a very seasoned coder, to go from ground level to tested and implemented that quickly. It can be done, and it can be done in a simplistic manner. But I think, like you're saying, you've learned so much from just doing the basics. It's like owning your first car. You probably learned quite a bit about how to take care of a car from that first vehicle. God rest its soul. Right?
Absolutely. Yeah. Yeah. Totally agree.
Yeah. All right. So how are you measuring your progress? I mean, are you journaling? Do you use spreadsheets? Do you document results? How deep are you into the back testing? Or is this more like you're still doing the coursework?
Yeah. So one of the things I kind of like about programming is that it's quite easy to measure your progress. Whereas you're a discretionary trader, or just a trader in general, some weeks you're up, some weeks you're down, and it's always up and down, and it's quite hard to know if you're actually getting better. Like, you're acquiring more knowledge, but are you actually getting better? I mean, with in a programming sense, either it works or it doesn't work, and you start to code things that are slightly more complex. Not to say I'm actually doing anything super complex right now, but things start to gather momentum, I guess, is a way to say it.
A good phrase. Sorry to jump in. A good phrase from Phil that just came to mind: shells. The idea of building a shell that can be used in any one script, but then applied to another. I know this is more of a kind of proper programming term that I'm, of course, a non-programmer, like kind of learning myself as I'm learning code. But building a shell that you can use, a construct that you might use somewhere else, whether it's, like I said, a moving average cross or a counter of how many bars since an event has occurred. These things can be useful to systems down the road. So building a subcomponent might be valuable, even if it doesn't turn into a fully fledged, up and running, deployed system.
Absolutely. I mean, I've found that even over the last couple of weeks. Like, if I create something, like a new script, I'm often copying and pasting blocks from past scripts into the new one and just tweaking it a little bit to suit. And then obviously adding to that as well. So yeah, and I mean, just to add on that, I have been I've got like a personal blog. I don't really promote it and put it out there, mainly because there's not really much on it. I've probably been a little bit slack on that. When I was doing a little bit of day trading earlier this year on demo, I should mention that, I was journaling all my trades on there with screenshots and that type of thing. So I was doing that. It's now sort of turned into a place where I just put important notes that I want to remember about programming. And then also, I'm still obviously looking at charts, quite a few times each week. And I find, the type of setups that I was looking for going back to earlier this year and into last year, I'm still saving those onto what you'd probably call like a watch list. And one of the things which I think is quite beneficial is watching those setups sort of unfold. Okay, so obviously you identify it before the trade signals, but then following it. So following it signals whether I take the trade or not. I mean, I've only taken a handful of trades this year. I'll still keep it on my watch list for the next sort of month or two, just to see how it unfolds, to see how maybe I could have better, just think about how you maybe could have better managed your stops and that sort of thing. I don't think I'm being very clear here, but keeping it on your watch list to watch how it unfolds past whether you took the trade or not. Like, don't just scrap it from your watch list. Keep it on there and see how it progresses and moves.
You know what this is like? This is like doing homework and flipping to the back of the book and looking at the answers instead of doing the work. When you actually watch the setup, I'm serious, when you watch the setup, you're working through the problem, even if you're going to get the answer anyway. You know you're going to get the answers to the test after the test, but it's kind of like, well, I still need to learn how to think about it. I think that's so cool that you're constantly kind of giving yourself these little mini quizzes of the setups. Did I identify it right? How could I have done this better? Was I early? Was I late? Is my stop too tight? Is it too wide? Etc.
Yeah, I mean, that sort of thing, I mean, I keep them saved there, and it's going to be a big help. It continues to be a big help in identifying better setups, better entries, and that sort of thing. Like, there's a lot to be learned from actually following a trade through.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
That website that I shared with you guys, and I hope, you go check it out, twitter.com. I'm messing with you guys, obviously. I'm posting a lot of my trades on Twitter, because finding trades like that and keeping a record of them that you can go back and look and say, on this date, at this time, this was the opportunity. My God, to be able to document that and aggregate it. Are you saving any like spreadsheets or Excel output of any of the systems?
No, not at this stage. I'm probably not at the level where that would be too beneficial in regards to back testing. But
sure.
Hopefully in the next couple of months, I'll be starting to build up a good backlog of spreadsheets.
There's a great quote I have here in my notes. I think it was from the originators of the C programming sort of suite language. Make it work, then make it right, then make it fast. Like, it's okay if you're just on the make it work part. That's what everyone starts with.
Yeah, that's actually really good. I like that, because I mean, some of the coding I've been doing, I know it's not the most efficient way, and I know it's kind of a little bit rough, but I mean, it's just first step. Yeah, exactly like you said, is get it to work, and then go through and optimize it, and
then get it right, and then get it fast. By the way, make sure you mistakenly attribute that quote to me and not to whoever said it, so that I get credit for it. Okay,
sure,
Zach Hurwitz said this. I'm messing around. Yeah, I mean, what are you studying and working on at the moment? Are there any resources that you're finding helpful right now? I imagine there are so many traders out there who are like, wait, if Aaron's saying that it's doable, then you're right. It probably is doable. I should go check this out. Where should they start?
Okay, well, I mean, I can share a couple resources that have been really helpful for me in learning Python, and I'm not saying you should go out there and start learning Python, but if you want to, Codecademy has an awesome course on learning, the good fundamentals of the language. It's a very extensive course. It's free, and every different sort of lesson, that's probably not the right word, topic, whatever, you have to actually write out the script. So you're not watching videos, you're not you're not just reading a book. It's very interactive, and it actually makes you write things out before you move on. So that's been helpful. What else? There's been I've done a couple courses on Udemy. I think one of them was called the Ultimate or Python Bootcamp or something along those lines. That's a really awesome course. So I'd recommend anyone who wants to learn, just the fundamentals of that language. That'll just teach you, like I said, the fundamentals of the language. It's not going to teach you how to apply it to a trading domain. But you've got to learn that to start before you can go any further. I've also been reading quite a few, quantitative trading books. Inside the Black Box is a really cool book by Rishi Narang. He's actually going to be on the podcast in a couple of weeks' time, so I'm pretty excited about that.
That's awesome.
Yeah. He'll be really good. His book is really insightful.
Is that something that somebody without any experience in quantitative trading could read and appreciate? Because I remember that feeling of like, I want to buy this book, but I'm going to feel like an idiot if I buy it and look at it and go, I got to Google like half of the words in this book. Is it something that you could get into, or is it kind of over your head, but you're going to try and get more of it over time? Or
it's probably a little bit. I mean, it's probably a little bit over my head still. But I kind of just take the attitude. It kind of just feels like sometimes I'm just drinking from a fire hose. Like I'm gonna take some of it in, and just the more I go over things, it's kind of like when you set out to learn something new. I mean, most people can probably relate it back to when they were younger, right? They had a favorite band. When they first discovered the band, they didn't know anything about them, but you kind of, when you're young, you're a teeny bopper, you kind of obsess over a band, right? And before you know it, in a couple of months' time, you know everything about all the band members and that sort of thing. It's very much the same. You know what I mean? You just kind of got to almost obsess over things, and you just start to learn more and more, and it just becomes almost like the more you go over the basics. Like I've done, I don't know, probably 3-4 Python courses, probably a few more than that actually. All just going over the fundamentals of the language, not even applying it to a trading sense, just learning the basics of the language. But it's been good to do it from different people because everyone has their own unique way of explaining things.
One thing, if I might jump in, you're kind of hitting on the Yoda principle. This is what I call the idea that like Yoda didn't start as Yoda. Like he wasn't a wise old sage when he was born. Right? I mean, he started somewhere. He had a teacher. He grew into be this incredible, teacher of other Jedi. But no one, is born with knowledge. Like you say, you start out somewhere and you go at whatever pace you can and you acquire skills, and eventually one day you can become, a 9,000-year-old, 900-year-old little green Muppet teaching Luke Skywalker. Right?
Yeah,
we all have dreams.
Yeah, and I mean that's the thing is like no one's born with the knowledge on how to do anything. You know what I mean? It's just a skill that if you want to learn, you just set your mind to it and you just go out there and learn it. So you just accept that it's going to take time and just be prepared to put in the work.
I was going to say, just remember, all traders started out thinking CNBC is where they're going to get like, finger on the pulse market knowledge, like with CNBC. Everybody believes early on, and then they get a little jaded, they get a little experienced, then they grow up a little bit, then they start searching, they go through the struggle, and those that make it through the wandering struggle are the ones who become professional traders. They, persevere.
100%. And Zach, just something I want to ask you, which I probably should have asked a little bit earlier, but you asked me about how I'm keeping track of my progress and am I journaling and that sort of thing. And there was actually a few questions that came in about that subject. So I'd like to put it to you and ask you, what tips or pointers would you give to other traders who need some guidance about journaling? Like what exactly should be in a journal besides what price you bought and sold at?
I think, okay, this is a good question. Every trader journals a different way. I journal like a scrapbook. Like I put some screen caps, some text notes, maybe an audio recording of like how I feel at the end of the day, and I just throw it all in a folder with that date. That's just me though, right? Some people want a Word document. Other people make a database or a spreadsheet. It depends on how quantitative or qualitative you are. For me, it's a lot of the visceral that I want to capture. I want to figure out how I felt that day, why I felt that day. Was it internal or external to the sort of trading ecosystem? Meaning, was I upset about something that happened in trading, or did I not get enough sleep the night before? Did I fight with my girlfriend? Did I kind of want to observe the behavioral triggers that might be happening around me too. There are so many other things other than just like what price you buy and sell. What was the market doing when you took the trade? Was it trending or was it a non-trending environment? Was it a big reversal day, that sort of thing? What type of trading day did it appear to be when you took the trade? Something I'm big on, numerically scoring your trades just on your own, your own personal scoring of 1 to 5. How confident were you in that trade? It's not bad if you take a 1 or 2 confidence trade, meaning low confidence. Presumably, your risk is appropriately smaller to reflect that it's like, hey, I don't think this is going to work. But if it does, then great. I'm in a wonderful trade for 8 cents of risk or some modest amount. What was your risk reward on the trade? How good was your entry? What time of day did you enter? Things like that. I think the more you trade, it's sort of like going out on dates. The more dates you go out on, the more you notice kind of commonalities. Like if the girl you're going out for a coffee date with doesn't show up for the first 20 or 30 minutes, she's like super late. Maybe that's not a good match. And for the record, for me, that would be a great match. I'm always running on Hurwitz time. Anybody who's taken me up on that free consult knows that I'm usually running 5 to 10 minutes behind. What a great, if it's 5 or 10 minutes, that's awesome. That's a success, Anyway. With journaling, I think you have to figure out what appeals to you, because journaling sucks. And we all know it. Nobody enjoys writing, especially about their losses, right? Part of what I talk about, like the circle of good trading, the last point in the circle is to review with clarity. It's your job to keep your head held high, look straight in the eyes of your trading report, and see it for what it is. Because if you're one of those people who and I've had days like that, I know we have all had days like this, it hits like 4:01 p.m. Eastern, and I'm like force quitting Thinkorswim. I'm like, get out of my fucking face. Like, I can't be looking at you right now because the trading report is so bad for the day. Nobody wants to get there. We all want to be able to look at it, and even if we have a losing day, kind of be motivated. Well, you know what I'll do? I'll take some screenshots of the day, and I'll be able to look back at what I saw when I have a clearer head. I can't tell you how transformative that is for traders. It's like holding a mirror up to themselves. They can finally see the struggles that they're experiencing. I used to do that when I was a younger kid in my teenage years. Here's a little bit of my teeny bopper, teen angst therapy. And by the way, we're going to come back to that. I want to know what band you were talking about. But I used to open a TextPad file on my computer, close my eyes, and just type, just sort of like stream of consciousness. After I was done, a couple minutes of writing, I would go back and I'd read it through and just observe my own feelings, like what I'm experiencing, but not saying, my own kind of internal monologue. And that was what helped me in journaling my own kind of thoughts and feelings and applying the same thing, like I was saying, a stream of consciousness rant. So maybe one day after, 250 episodes, we'll do for special subscribers, we'll release the unedited audio notes of Zach Hurwitz cursing at himself after a bad trading day. No, I'm just kidding. All right, now back to the important question, Aaron, because you almost glossed over this. You said you were teeny bopper and you followed a band obsessively. What band are you talking about? Because I know you're talking about a band. What is it?
I'd probably rather not say.
No, you have to tell us. You can't mention it and then not tell us. I'll tell you what. I'll tell you. I have a terrible one that I liked too. So go ahead. You give me one, and then I'll give you one.
I'm probably going to say Good Charlotte. That was one of them.
Oh my God!
I know there's a few others.
Oh my God, Aaron!
I'm trying to think.
No, dude. Okay,
I'm trying to think of a better example.
That's a great example. Thank you. That has made my night. The band I liked, prepare yourself. It was Creed.
Oh yeah, that's pretty shocking.
Did you just hear like 10,000 listeners simultaneously? Here, we keeping with the Star Wars theme, right? It's like, I sense a disturbance in the Force. Like 1,000 voices cried out at once. You know, it's like seriously, people are just like, good Charlotte and Creed. Who am I listening to on this
Yeah,
podcast?
it's a bad combo. So just going back to the journaling, let's quickly move
Sorry,
off
man.
that.
Yeah. Oh, come on, I couldn't skip over the band. All right, go ahead.
So on the journaling, like it's probably one thing to journal your trades and keep records of, what you've been doing, your activity. How often should someone maybe make a conscious effort to go back and review their journaling?
Do a small review every weekend, Saturday or Sunday. You don't want to do it end of Friday. Come on, nobody's got a clear mind at the end of Friday. We're all burned out, right? Small reviews. So we're talking maybe 20 to 30 minutes, and then maybe a larger review of an hour or two to review the weekly kind of notes. And remember, this doesn't have to be a regimented, detailed, multi-page report. Journal the way that you're going to journal. You know what I'm saying? Like, do what fits with your personal style. So make it enjoyable for you. Like I was mentioning, the scrapbooking. It's something I can do kind of on the fly as I think about it, as something strikes me about the day or something that I've written in chat. I can just grab that and copy and paste it. That's easier to me than writing a paragraph about each trade at the end of the day. It is going to take up a lot of time. Obviously, if you do this like every day, if you review the notes, it's something you have to add into your workflow. I don't know if daily review is really that important. I'm not trying to sound lazy here, but it really is. It's more about, I think, the weekly. One data point does not a trend make. So you're going to have terrible days. They are going to happen where everything is wrong. And, nothing's going right. The best setups don't work. You fat finger a trade and maybe buy too much of it, and then it goes against you. And you got to make it through it. It's the prepare yourselves, guys. Cheesy traderism incoming. If you want to be here for the good days, you got to be here for all of the days. You just have to show up and trade. You don't get to just show up on the good trading days. You have to make it through all of the difficult ones as well. But I don't think it's as beneficial to like necessarily spend a ton of time reviewing each day's notes until the end of the week. That's all.
Yeah. So I guess that kind of just goes back to that trading mantra everyone's heard 1,000 times, is just do what fits you. Like find a trading approach that fits you. Find a journaling approach that fits in with your schedule, and just stick to it.
You know why people react so negatively to that, though? It's because it sounds like we're talking about our like spirit animal, like our Patronus from Harry Potter. You know what I mean? Like, who is your style of trading that calls to you, Aaron Fifield? And it's not that easy. It's not like you find, I belong in House Gryffindor. Like, I belong as an RSI trader. It's never going to be that simple. I think what we're saying is like figure out what elements of trading really appeal to you. For example, I'm a very visual learner. I like pattern-based trading. That's just fun to me. It's more fun than, reading the tape, right? That doesn't mean that that's a bad strategy or that you shouldn't consider it or that it might appeal directly to you, but to each their own. And you have to find something that is intellectually fulfilling. And in the same way, hopefully, obviously, very profitable too.
Yeah, no, that's really well said, actually.
The trading Patronus part, right? The Harry Potter reference, obviously.
Of course.
Just messing around. All right, so do you mind if I keep going? Do you have? I know you've got some questions for me interspersed too.
Yeah, no, keep going. I know we've got a bunch here to get through.
I know. So. I gotta grill you, man. I'm sorry. This is a tough one. Are you ever worried that your work for Chat with Traders is like somehow spreading you too thin, maybe even like hindering your ability to become the trader you want to be?
Yeah, and I'm glad someone actually asked this question because it's been something I've been thinking about a little bit lately. Sometimes I think, yeah, maybe it possibly is, because it does take quite a lot of time to obviously run the podcast. Like, first of all, you've got to actually find people who qualify for an interview. Then you've actually got to get them to agree, and then you've got to lock in a time. Like, there's a lot involved before you even get to recording the interview. And then obviously it needs editing, it needs, show notes, all that sort of stuff. So yeah, there's a lot of work involved, and it does take up quite a lot of time. But I am learning so much from it. And I think whether I trade directly like the traders I interview or not, there's always a good there's always a few good takeaways in there for me, which I can apply to my own trading. And, they might just be something that just sticks in the back of my mind. But I mean, the time factor is something I'm aware of. And I think that's good that I am mindful of that. And one of the ways I actually plan on tackling that going into 2016 is I have a virtual assistant. I'm actually interviewing for a virtual assistant at the moment to help out with things.
That's great.
And I'm also probably bringing someone on to help out with research for the traders I interview. So that's definitely going to cut back my time quite a lot, which will allow me to spend more time on my trading. But I mean, in saying that, I am still spending 2 to 3 hours most nights on my trading. Mostly learning coding and programming and quantitative methods and that sort of thing. But I mean, one of the things which I really liked from one of the interviews I've done since episode 25 was Tom Dante. I think it was episode 36, I think. He was awesome. And one of the quotes he said was, "If you're not working on your edge, someone else is." And I really loved it, how he just went into depth, like really went into talking about how trading is such a competitive business. And it kind of gave me a bit of a wake up. I mean, even though I am spending a few hours each day, I always feel like I can be doing more and I should be doing more, because the ultimate goal for me is to become a better trader. And, there's guys who are doing this 8 hours a day plus, focusing on their trading. If I'm only doing a couple hours at night, is that enough? So short answer is, yeah, it has crossed my mind, but I also think the podcast is hugely beneficial to myself. And also, going off what many listeners have told me, also think it's beneficial to many other people, which I really like. So, I mean, I don't think I'm doing it just for selfish reasons. Yeah, and I mean, like I said, I'm going to be bringing a couple people on next year to help out, just take the workload off my hands. Not entirely, but, more hands make light work, as they say.
When you first answered, when I said, you're worried that it's hindering the ability to become the trader, and you said yes, I got chills. I was like, wait, so is this the end of the podcast? It's like, all right, guys, that's it. Thanks so much for listening to Chat with Traders. Last episode, we're gone, we're out. We got to go get working on our edge, because if not, someone else will be. I think it's such a great quote from Dante. Like, oh my goodness, that freaked me out the first time I heard it, because it really is true. It's like, while you're watching a football game, someone else is learning how to code in Python.
Mm-hmm.
That's probably the truth. So, like, stop messing about. Like, you've got better things to be doing.
Yeah, I almost want to get that printed out and stick it on my wall.
Yeah,
I think it's a brilliant quote. And that's definitely one of those points that's stuck in the back of my mind. So yeah, I mean, I wouldn't have heard that if it wasn't for the podcast, So there's so many benefits to doing it.
And especially some of these perfect little quotable moments, writing them down in your own handwriting or printing them out. I mean, putting them on your wall next to you. I know this is kind of a common traderism. This is a thing that we all do. I remember when I was in college, I would write, never forget to sell this if it breaks below so-and-so, and put it on my monitor. Start screaming about something. My buddy would come in the room and he'd look at the Post-it notes and he'd pick one of them off and he'd hand it to me and he'd go, well, it's your handwriting. Like, you wrote this and now you're complaining about it. And like, you should maybe listen to this guy who wrote this Post-it note that is in your handwriting. You know what I'm saying, dude? Kind of pointing out to me like, hey, listen, no one else is in control of this. Like, you're the one who not only fails, but sees the success. All you have to do is take it.
Absolutely. And I mean, I think that's something I'll just add in there is one of the things I've kind of been aware of, but it's just kind of really become more obvious, is that in trading, no one's there to tell you what to do. Like, it's completely you and the markets. Like, it's not like, okay, so if you're running a business, you've got clients, like you have deadlines, you need to get things to people before certain times. When you're trading, it's just you and the market, and no one's there to tell you to put in the time to, to tell you what you should and shouldn't be doing. Like you need to really take responsibility.
You're only accountable to like the math and the markets. You're not accountable to anyone else. There's no driver of what to do next.
Absolutely. And I mean, that's become sort of really obvious to me this year. And I think, I think one of the good things to be is just really mindful about and honest with yourself. Like, are you putting in the time? Are you doing what you can be to, reach your goals and reach the level of trading that you want to be at? Like, if you're not, then you need to, take a step back and think about, well, how can I change things? What should I be doing?
That's another interesting point. Like, it's okay to be not serious about trading. It's okay if you're not trying to learn how to trade right now, or you don't have the time, you don't have the capital, you don't have the patience, not the right life arrangement scenario. You know what I mean? It's okay if you're not serious about trading. It's okay if you're serious about trading. You know what's not okay is telling people you're serious about trading and not being serious about it. Now, I mean, we're kind of preaching to the choir, right? If you're listening to this podcast, odds are you're doing the hard work. You're seeking out, further education on these subjects. Like, you're probably doing the right thing. But there are plenty of people out there who claim to be putting in the effort and the time, and they're really not. They're just kind of fluffing themselves up.
Yeah.
And like we said, you want to be able to look at your report with your head held high. You want to be able to say, I gave it my all. I did absolutely everything that I possibly could. This is a point I was going to make later, but it kind of comes up right now. It's like there are two universes from this day, from this point forward. One in which you do whatever it takes to become a successful trader, whether that's weeks or months or years from now. And then the other universe where trading's so tough. It's a young man's game. Glengarry Glen Ross reference. But people kind of complain and commiserate and I'll get around to it. Maybe I'll learn risk management. But what about this indicator? And they get easily distracted and pulled to the next thing. They never really take stock of where they are or where they want to be. The two universes. It's the same universe, but in one you succeed, and in the other you're always remembering what it would have felt like if maybe you had tried to succeed just once. You can choose which universe you live in. It doesn't matter if you're 16 or 60. You get to choose which world you go forth in. It's easy to, it's easy to get psyched up and say it. It's a little harder to actually put it in practice. I feel like that's what trading is all about, though. It's like the repetitive. It's the consistency. It's not about getting psyched up one day, having a good Monday trading, and then screwing up Tuesday, Wednesday, Thursday, Friday. It's about every single day for the next 20, 30, 50, whatever years of your trading career. Mm-hmm. And that's why you have to plan for that longevity.
For sure.
So tell me, this is the question that I know everybody asks me if I know, like I've got some secret information about which are your favorite episodes, but are there any interviews that have resonated with you particularly? Are there highlights, kind of memorable takeaways, episodes 25 to 49?
Yeah, that's another question that came up quite a lot. And, I totally understand why people are asking that. It's a good question. And, this is obviously fresh in my mind, but the interview with Haim Bodek last week was, I was pretty stoked with that interview. Pretty stoked just to get him on the show. Just his whole story is so fascinating, and just like his level of understanding on the market microstructure is just probably unfathomable for most of us.
It's like having Julian Assange on your program, or Edward Snowden. It's like literally at that level, guys. I hope you realize how big Haim Bodek is. He's awesome.
Yeah, like just the magnitude of what he did, you know what I mean? Just the whole story was really cool to be able to speak with him and get it on the podcast. And I also liked how he spoke about payment for order flow, because that's just something I was unaware of. Like, I'll put my hands up and say I knew nothing about that. And I think probably many people listening were unaware of that as well. So that was a really interesting topic. Just another one of the benefits of doing the podcast. Yeah, and then obviously I've mentioned Tom Dante reinforcing how competitive trading is. And one of the things he also mentioned, which I found really interesting, was learning from your mistakes quickly not just learning from your mistakes, but learning from them quickly. That's another one of the things that's just stuck in the back of my mind. I think you're going to be able to say this in a much more poetic way than I can, Zach. But if you are continually doing average things, right, you're just continually getting average results. And maybe if it's not even in trading, maybe like, just in life, you begin to accept that, whether on a subconscious level. I don't know. I mean, I don't know enough about this type of thing. It's just kind of what I'm almost seeing here. Is if you become used to poor results, it's harder for you to actually progress and move forward like you want to. I don't know. Did that make sense?
Well, it's not only, you know what I think it is? It's the accepting of the results. If you look at poor results and go, that's not me, I'm better than that. I can do, like, you're fighting the kind of malaise, the kind of the complacency. I picture it as like molasses or like, sluggishness. That's what I'm visualizing here. This idea of like, well, but this is all I am. I'm just a suffering trader. This is that victimization loop of like, but the market makers, they know where my stops are. They're always going to know. It's like, well, come on, man. You gotta be not okay failing. You gotta fight back. Get up off the mat and at least throw a punch, even if you're going to get knocked down again. Being unwilling to accept them is the important part. And I like that, becoming used to poor results. You're just...
Yeah, like you just kind of accept them and it's not okay. You've got to be, again, it just comes back to that thing, being very mindful of where you're at and...
being self-aware.
Yeah, self-aware.
Exactly.
That's it. So also Jack Schwager was phenomenal to have him on the podcast. Obviously learned a lot from him. Very well spoken, incredibly insightful for obvious reasons.
I was going to say, if he wasn't, he would be a super big letdown, wouldn't he be? It's like Jack Schwager saying nothing. No, he was great. It was a fantastic interview.
And that was, he actually told me afterwards that's the longest interview he's ever done, which was pretty cool.
Goodness.
I'll take that.
Yeah.
Peter Brandt, he was another really great interview. One of the things I really took away from speaking with Peter is, I don't know if simplicity is the right word, but I just love how the type of setups he trades, they're very, I don't know if simple is the right word, but I mean, they're just horizontal support and resistance, trading a longer time frame, and obviously it's just worked out very well for him. I learned a lot from his insight, also about risk management, that it's okay to take small positions. You don't have to swing for the fences every trade. And that's why he's continued to stay in the game for, 45 years, which is incredible.
Yeah, that's quite a trading record. You know what word kind of comes to mind when I think about Peter Brandt? It's almost like elemental. Mm-hmm. Like we're dealing like elements of nature. We're dealing like the building blocks of the world around us when we talk about his trading style. And I think that's why it's so successful. It's not a bunch of bells and whistles and this particular little indicator and this tweak and this particular setup. He's trading from one place on the chart to the next. I think he's reduced it, or distilled it, I should say, rather than reduced. Here I am, a novice trader in my, when I compare to Peter Brandt, talking about how he's like reduced his trading. He's distilled his trading down to the essential elements. And I think you were going to say something to this effect, that kind of, all the great traders you've interviewed and what you hope to bring to your own game is that clarity of vision for oneself and one's trading. Like, you must know who you are, know what you're good at, and know what you suck at. Like, if you want to feel good, focus on what you're good at and good at alone, right? And that's all. If you want to get better, you got to know every aspect of yourself. You have to know every angle, your best side and your worst side.
Yeah, definitely. And another great takeaway that just comes to mind from the interviews since episode 25, Dan Shapiro, he was really cool, a lot of high energy, obviously, and just really dug into the emotional side of things, which I think was good for a lot of listeners. That's something I hear come up quite often. Obviously, I speak with many listeners through emails, Twitter, etc. Psychology side seems to be, quite challenging for many. That's definitely one to check out if you haven't. And another thing he said, which I quite liked, and I'm paraphrasing here, but he said, like, he kind of took a step back and looked at a chart and thought, where can I consistently make $100 from this chart? And I really liked that point. I mean, I don't know if that's going to resonate with everyone, but just looking at a chart and seeing if there's something that comes up, something that repeats, that you can act on and you can take out just a small chunk. And that's something also Linda Raschke spoke about, is just taking a trade and just taking out a small chunk of a move and just taking it onto the next one, do it again.
Well, it's training you to think about repeatable events rather than a one-off. Like, everybody likes to talk about KBIO, the massive short squeeze, kind of takeover, reverse merger, blah, blah, blah from the last couple of weeks. Everybody likes thinking about those giant percentage moves, but they happen extremely rarely. Like, why would you look at a chart and observe that one event and focus in on that? That's like, instead of observing that the sun is out, you pay attention to the one day there's an eclipse. You talk about how dark the sun is. It's like, no. You're focused on the wrong part of all of this. Like, look at the other 364 days out of this year. You know what I mean? Where there's no eclipse.
Yeah.
You have to see the chart for what it is. You have to, see opportunity in a consistent sense instead of just this one particular crazy event that, traders kind of habitually focus on. And why not? They're exciting. They're kind of a marquee event, right? There's something that everybody's paying attention to. I think this is why momentum trading is so, like, highly sought after. It's exciting. It's sexy, right? You're trading where there's big movement. I understand it. That doesn't mean it's reliable or it's the best,
Yeah, that's a great point.
So I cheated. I was saying, I guess one of the points that I think you're going to be answering this next question with, but what are some of the commonalities between many of the, traders, and particularly the great traders that you've interviewed?
Yeah, so like you mentioned, obviously they are very clear on who they are. They know what they do, and they know what they do trade, and they know what they don't trade. Mm-hmm. So I think that's important, is being able to answer that for yourself and accept what you are going to trade and what you're not going to trade. That's something I've definitely taken on board. We're speaking kind of like similarities here. So another thing I think is a similarity between many of the traders I've interviewed is they haven't succeeded by chance. So it's not like they got to their level of success and made the profits they did by a fluke. It was it really came down to their incredible work ethic. I think that's definitely one of the big commonalities between everyone I've interviewed, and a lot of them took years to get there. I haven't done a tally, but many traders who I've interviewed have said that they took 4 or 5 years before they started to see some consistency. And many of the traders I've interviewed have obviously been trading a lot longer than that. So just understanding and accepting that it's going to take time.
You have to just stay alive for the first few years.
Yeah.
That's really all it is. It's not about thriving. It's just not dying as a trader.
Mm-hmm. Yeah. So that's definitely a big one. They haven't got to where they are now as a fluke. It comes down to their work ethic. That's what I strongly believe.
So how are you applying kind of like what you're learning to your own trading and your methodology?
Yeah, this is another question that came up quite often. So it's a tricky one to answer, actually, because it's not like I'm applying everything I'm learning in like a systematic process of absorbing their knowledge. But like I mentioned, certain things just subconsciously stick in your mind and they stay around. I think just overall, it's just given me a deeper understanding of the landscape of trading, and it's going to pay off in the long run. Like there's just no way possible it's made me I'm worse off for doing this. Some things that I've heard have given me extra conviction that I am doing the right thing, which has been nice. But it's also, there has been a couple moments where I could have easily been distracted by the shiny ball syndrome, But that's something I've always been very conscious of. So even if I don't trade, I think I've mentioned this already, directly like some of the guys I've interviewed, obviously that'd be very tricky. There's always things you can take away and learn and just keep in mind.
You know what it is, man? It's that everybody thinks that there's like a secret conversation that happens between you and the guest, like shortly after you wrap up the interview, where you're like, "Hey, so Peter Brandt, like just tell me, man, like what do I set my RSI to? Can you just tell me like what length of moving average?" And Peter's like, "Oh, yes, you just have to use this and this." And he gives you the like inside scoop. So people want to know, like, where do you get your hot tips from?
Yeah.
I'm totally kidding.
And I think it's important that I say this, and I don't want to be a dick about it, but like everyone who's listening has the same insight that I do. So we're both hearing like the same things. I just want to express that to make sure that people aren't just listening; they're actually listening and really sort of absorbing the content, taking on the wisdom that many of these traders are sharing. Because it's easy to do that. It's easy just to listen and not act on it. Like, what's that saying? Knowledge is useless without action. I don't know, paraphrasing. Something along those lines.
So tell me, what were your beliefs and expectations about trading, like before you got started in trading compared to now? I always think that's funny to ask people, like, when you were not a trader, what did you think about trading that the minute you got in here, you're like, oh my God, I was totally wrong about all of this. Is there anything that's dramatically changed compared to when you started?
Yeah, I think when I first started, I definitely did think it was going to be a lot easier than it is. 100%, I thought that. I thought, if I just read these few textbooks, I should be good in 6 months, and I'll, be making substantial money. Right? That's what I thought, and I remember thinking that traders just must laugh at the rest of the world because they just earn so much money. And I still think that probably is the case for many, but it takes a long time to get to that point. So it's definitely a lot harder than I thought. And I also realized that there are many ways to succeed. I know we've all heard this before, but that's one of the things that I understand is, obviously I was introduced to trading with a specific style and a specific methodology. But, I've since learned that there's just many, many ways to succeed and to make money in markets. And it's also your background is irrelevant, I feel, meaning like your level of education. I don't think that's because, many people use that as an excuse. They're like, oh, I don't know this, I don't know that.
Yeah, well, I never took a class in finance, so who am I qualified to? I know what you mean. Yep.
Yeah. So I think people's background is irrelevant. It's what do they say? It's about where you're going, not where you've come from. So,
well, it's saying that trading is a meritocratic thing. It doesn't matter who you are, what car you drive, how tall you are, how good looking you are, who your dad was. Nobody gives a shit. It matters about your next trades. It's not even about the trades you have taken. There's the saying of you're only as good as your next trade. Not even the trade you're currently in, but the next trade. Because a man who can't find another trade and who can't manage that future position, that's a person who's done trading.
Yeah.
You know what I'm saying?
Yeah.
It's an ongoing process. And if you make it anything less, if you make it a one-off process, so to all you guys out there who have all of your account in some shitty little pharmaceutical letter ticker stock, you know what I mean? This one's for you guys. You got to plan on trading tomorrow too. You can't just risk it all to try and double up. That's not a strategy for success. It will work until it doesn't. And when it doesn't, of course, then you're done trading.
Yeah, it's got to be sustainable. I think that's a really key word, actually. That's something I've picked up from, I think that was Mike Bellafiore. I've probably mentioned this on episode 25, but that's a really key word, I think, to trading success is have an approach that's sustainable. But another thing that's changed, or I've come to believe about trading, is that things can be as complex or as simple as you want to make them. And a lot of people say keep it simple, and that's probably a fair thing to say. But I've come to realize that some people actually thrive of complexity. And I don't think that's a bad thing. I think that's okay. But I mean, it just goes to show that it's, you can make this fit you. So it can be as complex as you want to make it, or it can be as simple as you want to make it. That's another thing I've come to realize.
I think it's the difference between inductive and deductive learners. Inductive learners tend to get 80% of the material, in 20% of the time. And then there's the deductive people who will get 100% of the material, but maybe in 100% of the time. They're going to take longer, but they'll get full completion, right? That's just two different learning styles. That's not to say one is better. One might be faster, one might be more holistic. I mean, just depends. And there's not to say that one really is superior in the market. I've seen successful traders of both types.
Yeah. So let me throw this back to you, Zach. What beliefs did you have, and what expectations did you have about trading before getting started?
Oh my God, I'm thinking back to. All right, this is really embarrassing, guys. I used to chart like channels on Google Finance charts. I remember I'd be in class and I'd pull up a ticker on like Google Finance. This is back in like 2007, 2008. And this is before I had Thinkorswim even. And I thought it was going to be so easy as to define two trend lines and just buy every time it hits that lower trend line and sell at the peak. Like I was measuring out how much money I was going to be making if I was trading 2 or 3 or 500 shares. Like I was counting my money. Like I had planned to make this with absolutely, no deviation, no wrinkle in the fabric, and you start trading live, and you say, well, what do you mean I didn't get filled? Wait, what do you mean commissions are? Oh, what do you mean I just clicked that button too many times and now I have to pay extra commission? It's just you start appreciating more of the friction. The loss to entropy, just the kind of the energy loss, and therefore profitability loss in trading that you don't account for. You think it's going to be so easy, as you say. I remember thinking that the markets were going to be stable. You have to remember, I learned about the markets in 2007 when things were going perfectly fine. There was just the first inklings of some systemic crisis. What does that mean? Systemic? You mean it hurts the whole system? How could the banks be interwoven? I mean, nobody knew what subprime was, credit default swaps, etc. All these derivatives. I think the markets kind of were a fierce reality check for everyone around that time, that they are violent, that they are uncaring. They're like nature. They'll burn you or freeze you or blow you off a cliff, and they don't care because you're just another animal on this planet. This goes back to that idea of like elemental. When you're dealing with the elements, they can be friendly, they can be quite indifferent, quite scary, and we have to have respect for them. I guess I kind of had that arrogance of, we as humans will control the elements around us. Man versus nature. What if it's man versus financial markets nature? Oftentimes in trading, it's not you versus them, it's you versus you. That's a concept I know a lot of people have said before, but that's what makes for such an evenly matched battle. And that's why trading is so hard. You are always fighting your next limitation. You are always struggling to take the leap to the next lily pad, the next stepping stone, without being able to see it sometimes. There's a great quote, sometimes you just have to take the leap and build your wings on the way down. And of course, that's a very ominous quote if you're not building your wings. I mean, that goes back to the two universes. If you're working in that first universe where you're working hard to be a great trader, you're pretty confident, I'm going to sprout wings any minute now. If you're not, you don't have much faith. You're just sort of biding your time until you hit the ground. And that kind of grim reality, of course, no trader wants to hear. This goes back to why trading education is such a marketing-driven kind of industry. People want to be enticed. They want to be encouraged. They want to be uplifted. They don't want the reality check. They don't want the kind of the grim information about risk management. They want the sexy. They want the exciting. And there's definitely something to be said for being engaging, being entertaining, and relatable. But there's also something to be said for teaching people survival skills. You know what I mean? It's like being a survival instructor and trying to just show people, I don't know, pictures of hot girls in outdoor clothes or something. I don't know, hunting clothes or whatever. It's not going to do them very much good when they're freezing to death and they forgot how to build a shelter, you know?
I think this might be a good time to say a quote. Which how's that go?
Yeah, absolutely. Everything that we've been taught up until this point has been to make us feel better than it could ever make us trade. We're given all these tools that make us feel important and on the pulse of the market. It's almost like we're in our own Fidelity commercial of like, aren't you a modern trader on top of, the fast moving financial markets? Well, you and your analytics is this cheesy kind of like, get psyched, Mr. Trader, because you're going to be powerful one day. Truth is, it's like the little speak and say stroller you give to a toddler to make them feel like they're interacting with the world around them. And really, it's just keeping them busy. It's the same thing with our indicators, our, crappy little beginner technical analysis. It's unfair because I think there are people who are really putting in hard work, trying to learn the more, like you're saying, some people thrive on complexity or they seek it out. Those who are looking for the more sophisticated pieces of technical analysis, like they deserve access to it. Quick little plug. That's why I'm so adamant about teaching the institutional trading strategy of volume weighted average price at thevweb.com. No, I'm just kidding. No, it's so important that traders realize what we're given is to occupy us, to kind of I don't want to say waylay us, but to kind of hold us back, to occupy us. I think is the best way to fill our time, to pass the time, to bide our time. That's really what it is. And it's insulting when you realize that because we deserve better. We're the same people as, I don't want to say Peter Brandt because he is such a legend. It's not like all of us are Peter Brandt, but we're all human beings. So is Peter Brandt. What's to say, when he started out, he didn't doubt himself. I bet you if you asked every trader, did you ever doubt yourself? Anybody who tells you that they always believed, I mean, they're just straight up lying. I think we talked about this in my first interview, the kind of poisonous self-talk that traders go through when you're really down on yourself. Like, why do you think it cuts right to your core when you know what to say to push your own buttons? It's because you are you. You know your weakness. You know what you're the most ashamed of in your trading. You know what you are so bad at that you don't even want to tell your other trading friends about. You know what you do. You don't have to tell me. You don't have to tell Aaron. You don't have to tell us. That's fine. But admit it to yourself. Start being honest with yourself so that you have more, I want to say like self-credibility, like self-esteem, self-value, worth. So that you start trusting your intuition. So that you say, I'm pretty self-aware of this. Like, I know if I'm going to screw this up. I'm not screwing this up. This is a good trading approach. And it's okay if I go through a drawdown. Because this isn't me. This is the approach that I'm taking. It allows you kind of shield or deflect a bit of the burden, the ego blame that we all put upon ourselves. And if we're not careful, like you were saying, you're not accountable to anyone. Well, you're also not protected or bolstered, kind of emboldened by anyone else. In a normal like business, in a partnership, you have partners who are going to say, oh, you're having a bad day? Well, tough shit. We got work to do, buddy. Let's go. And psych you back up. Many traders like really don't have that. That's something that a lot of traders who reached out to me from the offering from episode 11 have said, I don't know any other traders. Where am I going to meet them? Right? On a forum online at like a meetup group? Like, that's ridiculous. Would traders succeed without a kind of social element? I don't really know. Like, if you ever, weird thought experiment, right? If you locked a trader in a room, you gave them enough food and water and air, of course, but like they had enough time and money, I guess. You got to give them enough of everything, right? But would they be able to really succeed in trading if they had all the trading books, maybe all of Chat with Traders podcasts, if they had everything except for actually connecting with other traders and being held accountable to other traders and seeing how other traders do it? I think it is so instructive to see other traders struggling with the same things. It is cathartic to go through that. Oh my God, thank God I'm not the only guy who gets stopped out at the lows. Or, buys a stock today and it goes nowhere and you forget about it tomorrow. And of course, that's the trend day. People need to see that you are doing something that is perfectly fine. It is right. It is part of the path. And it goes back to that whole like trusting of the process that we young guys get to be like, what the fuck are you talking about? Trust the process. We're too young to appreciate any process. We just see the hard work and the struggle, and we're waiting for that process to pay off. I'm checking my hypothetical watch, my Rolex, right? I'm kidding, I don't have a Rolex, but looking at my watch going like, when is this process gonna pay off? When I'm 30 or 35 or 40? It's hard to trust in the process when you're early in the process. You need to connect with other traders who are going through the same thing, maybe a little further along the path. Or instead of looking up the ladder, maybe you should look a little further down the ladder. I mean, this is something we're going to be talking about, working with other developing traders who aren't at the same level as you. This goes back to kind of how I got really passionate about trading. I moved from it just being a fun thing to do while I was looking for a job fresh out of college and into something that I could do for the rest of my life. What do they say? If you love what you do, you never work a day in your life.
Yeah, that's a brilliant quote, and I really actually like that experiment you kind of suggested there. I think that'd be really interesting to find out how people would perform in that type of environment.
Who do you want to lock into a room for like 6 months? Do you have any traders who you want? We could pick a really annoying trader and just lock him away for 6 months and not have to talk to him. If you volunteer me for this experiment, I'm going to be pissed, Aaron. No, I'm just kidding.
No, I'm thinking some of the Twitter trolls.
Yeah, exactly. We'll just lock them in a room with each other, and yeah,
and they can prove themselves there.
Oh, that's too funny.
So let's change this up a little bit, because we got a lot of questions coming in that listeners want the answer to from you. So I've got a big long list here. I mean, we've already over an hour into it. I think this is going to be a long episode. So
I think so too. But did you want to? I'm sorry to interrupt. Do you mind if I get one more question in before we move on to my topic?
Yeah, sure.
You speak with so many of your listeners too, and I got to applaud you for that, because look, I thought I talked to a lot of traders. Guys, trust me. You think I have it bad? Aaron. I love that you guys reach out to him. I know Aaron does too. He doesn't want you to stop or anything, but it's great that you get to connect with so many of the people who say, I'm sure, overwhelmingly positive things about the podcast. Are there any common struggles? This is maybe that cathartic moment of show people what everybody experiences,
Yeah, so that's a good question. Some of the things that tend to come up quite often in the emails I receive, which is awesome. I love hearing from all the listeners and that, so keep it up. One of the things that keeps coming up is many people think they're so close to profitability. They think they're almost there. I don't know that I have the solution for that, but that's definitely a common theme. People think they're very close. They've almost made it. They've almost got consistency, but they don't. Not yet, they don't. Maybe you can expand on that. Why do people always think they're so close? Are they so close, or is there something missing there?
Yeah, I know what you mean. I don't think people are right. I'm sorry to give you guys the bad news. I don't think you're as close as you think. That doesn't mean you can't get there. That doesn't mean it's unattainable, but it's a lot further than you think. I mean, look at Aaron. We were just talking about this, man. 6 months ago, or whenever, right? We expected we were going to have a working algo by now, but there's a million things that come up. Life gets in the way of your best laid plans, and that's totally fine. I would say if you asked a room of 100 traders if they're good or close to profitability, 99 would tell you yes, and the one who didn't say anything is the profitable trader out of the bunch. You know what I'm saying? The people who are the most vocal are often not the best traders. Sometimes the quiet, diminutive, tiny voice, just oh yeah, I'm over here just watching the markets, no big deal. But I understand the wanting to feel, hey, I am this close. I am right there, man. And if it just, if just risk management, if I could just nail down risk management. And it's guys, people write books about risk management. People write multiple textbooks about risk management. People's jobs, in some cases, are to be risk managers for a firm. You know what I mean? This is not something you can just master quickly and then you'll become profitable. It's like an engine. It's a million different intricate parts all working together in the right order and the right rhythm. And that's what's really important about when we keep saying, find something that fits to your personality. We're saying, find something that is moving to the beat of, the song that you are playing, so to speak, right? I mean, you want to play something in rhythm with what you're playing. You don't want it to be a total mismatch that requires you to, let's say, wake up at a totally different, hour of the day, or trade a different style, or trade a different product. Maybe you're not you don't like trading Forex, but you have to trade Forex, for example. I don't want to discourage people. I don't want you to think you're never going to get it. It's just be realistic with yourself about how long this is going to take. Part of this is, and I think here's what you're getting at, managing expectations. If you don't manage your expectations well, you are going to get really upset at yourself. The poisonous self-talk is going to come back. I'm sure, Aaron, you even felt that. Like, you get discouraged sometimes when you say, oh, I should be a lot further along. God, if only I had more time, if I'd spent more time on the code. This isn't your fault. Come on, you know what I mean? Like, it's fine. We're talking about a multi-decade long process, and you have to treat it like something.
Yeah, and I mean, that's something I was going to add, actually, is, interviewing Kunal, he brought this up on episode 20. He said, what is it to spend a couple years now? Just accept it's going to take a couple years. It's going to take a few years. Just really drill down and learn what you can now, because this is something you very well might be doing for the next 30 to 40 years. So I think, that's something worthwhile mentioning onto what you said there.
Yeah, you don't need to be good right now. You have to be good when you have more money, when this is a higher stakes game, when you're highly experienced and you know exactly what to be looking for. That's when you need to be good at trading. You need to keep, like a sponge, absorbing information until it's your time to strike and dump all of that information back into the market. And it's okay if that's not right now. Traders are so adamant about proving to others that they're real, that they're using real money. It's like they're so worried about being considered fake. They got to go prove it with real money. I know this is what you're going to say. They rush into real trading, right?
Yeah. And I mean, I think it ties in really well, as many people also seem to be trading knowing that they don't have an edge, like actually knowing they don't have an edge, or they're very unsure about things.
You got to fake it until you make it. They got to just get that experience. And that's what everyone says, right? You got to go really experience the markets to learn anything. And it's like, but I don't know what strategy I should be trading. What am I doing? Am I just watching? Yeah.
Yeah. And I mean, they kind of, it's like they almost rush into trading real money because they feel like that's what they should be doing. Even though, everyone knows 90 to 95% of traders fail. I mean, I don't know where that statistic came from, but I'd say it's pretty accurate. I'd lean more towards the 95%, but it's a game where so many people fail, yet people just rush into it, and I think that's probably the wrong approach.
When people ask how can that be if there's a winner and a loser to every trade, well, of course, traders are not equal size, right? There are some disproportionate traders who are much larger and represent thousands and thousands, many, many percent of the failing traders' accounts, all aggregated, are under the control of the few separate solid traders. That's your goal, is to be a black hole of wealth, to just absorb and kind of attract money wherever there's an opportunity. Because if you're constantly growing in both skill and in account size, who cares when you get there? You're going to get there. You can rest easy in that and kind of act in a risk-appropriate manner, confident that you will arrive eventually.
Totally. So let's roll into some of the questions that listeners contributed that they want you to answer. So I guess probably the first question is, how did you structure your study when you first started out? I think that's a good place to start, right at the beginning. So how did you first structure your study when starting out?
Well, you remember what I said about Yoda, right? He didn't begin like Yoda. He probably was just, he wasn't a master when he started out. I didn't really structure my study at all because I didn't know that I needed to structure my study. I was one of those traders who thought they needed to get that real-time market experience. I was trading when I was still in college, just the last semester that I was at Tufts up in Boston. And I mean, I think back to I spent a lot of time on Tim Knight's website, Slope of Hope. He's awesome. Evil Speculator, another blog that I spent a lot of time on that I think they're still up and running. I really was seeking to connect with other traders, other people. And when I found chat rooms, it was a step closer to real connection. And eventually, I think I really took it to networking and connecting with traders, kind of an individual connection and study via Skype or the telephone or even just email exchange. And I think that's, we were talking about the social aspect of trading before. Like, networking cannot be overstated. You absolutely must start trying to find other people with whom you can connect, even if it's just other developing traders. I think part of my like trading development, really going from like an okay trader, an intermediate trader, to a more advanced trader, was counseling other traders with whom I'd interact, almost just as a peer, as a friend, like not as a trading coach. Um, I think they saw that I had an aptitude for trading and teaching, and they wanted to learn more about how I was able to pick this up like relatively quickly. That encouraged me to kind of evaluate, like, is this reproducible? Is it replicable? Can I counsel others on it? Like, can I observe? Am I self-aware enough? Am I aware of, let's say, others? You might recall, I think, from the first episode we did, so episode 11, the Greek axiom, like, you cannot see that which is in your own knapsack. You can't see the thing you carry on your back. You know what I mean? We all struggle to see our own problems, but it's a lot easier to see the struggles of other traders. And I think, as I was saying to something from a prior question, you don't have to look just up the ladder at who can help you. Sometimes you look further down the ladder to who you can help bring up. That really reaffirms the fundamentals of your own trading game. And that particularly helped me to develop, because it made me ask the question of, like, what are they doing wrong that I also do wrong? And what are they doing right that I could be doing? This kind of goes back to, I think, like when I worked at a recording studio back in college, I always thought it was easier to gain insight from like what not to do from working with amateur artists versus like really professional, seasoned, they kind of like make it look easy guys. I wanted to know how the developing musicians would screw up, so that like I could see how other guitarists or other producers or recording engineers would similarly screw up. If the guys I was working with were all just pros, like the best in the business, I'd probably not absorb like just even 1% of what the pros were doing. They make it look effortless. The struggle of the amateurs, in a way, was a better learning experience for me than watching a seasoned veteran. I think it's the same way with trading. There's real value in being connected to other developing traders. We were just talking about how it's like cathartic to hear somebody put a voice to the same struggles you thought you were the only person who ever experienced it. You know, it's very humbling also to realize that even the best capitalized and best, backgrounded people, like the people who, let's say, have a quantitative finance degree. Listen, I love you guys out there, but it may or may not help you. There are plenty of people with quant finance degrees who suck as traders. They may be great systems engineers. They may be great analysts. They may be superior mathematicians. They're probably all out there like cursing my name right now. But you know what I'm saying? It's each trader is his own person and needs to be self-aware enough, or needs to know, like we said, your strengths as well as your own weaknesses. So early on, connecting with other traders was such a huge part of me going from being just okay to like, how am I going to be better than this guy? How am I going to be better than the best? How can I, maybe just in a more incremental way, how can I just be a better Zach? I don't need to be Paul Tudor Jones tomorrow. I'm probably not going to be anyway, so why not give up on that dream? It's like the difference between goals and dreams. Dreams are like, one day I'll figure out how to get there. Goals are like, I know how to get there, and all I have to do is X and then Y and then Z. Kind of focusing on the goals for now. You'll get to the dreams. The dreams will come, but they are a series of components. And one of them for me was like connecting with other traders, having a more personal engagement and involvement with the markets. I don't know. It would really kind of freak me out if we had to truly be alone as traders. Not only is it fun, it kind of keeps us, in good spirits, and it keeps it lively, and it's more enjoyable. But I think there's a real educational benefit to it also. Short answer: no structure early on. I was meandering. Like I went through the struggle too. I took 2 and 3 month long breaks from trading, where I really had to ask myself, like, am I cut out for this? Is this the right business for me? Should I be taking my skills and going elsewhere? And this is 2008, 2009. I'm sure a lot of people were questioning themselves at that point in time. It was a weird feeling back then, and I don't even know if I have enough perspective, because that's right when I came into the market. But I just remember the thought of, so I'm 22. I've got a degree from a good school, and the people I'm competing with have 15 to 20 years experience working at Lehman Brothers or Bear Stearns or one of these firms that has let 150,000 of their employees go, and all of a sudden I'm competing for a job with these guys. I'm outclassed. And that's kind of where I started with trading. I knew it was something I could pick up on relatively quickly. It's something that had always interested me. Why not me? And I think that's where every trader kind of starts. It's almost like, maybe I'm not going to be the guy to win the lottery, but couldn't I learn something about price patterns and markets? It's almost like I may not be smart enough to be the next Chaim Bodek, but I'm smart enough to realize that this can be done a better way. Maybe it's managing your own retirement. Maybe it is just a pure active trading, like a speculative account. Maybe it's your dream is to enact, like we say, like a quantitative system. I talk to a lot of non-traders who say, it's always been my dream. They're usually engineers, right? Guys who look at the markets and they say, this can't be that difficult. And of course, I laugh because, you and I know this, like, oh, it's so much more difficult than you possibly can imagine. I think we said that on the first episode that I did with you. It was, everybody thinks trading is like 8 hours of making, $1,000 an hour and doing cocaine off of a stripper. Like in reality, it's 20 hours of like lonely struggle every day in front of a series of computer screens. It's not quite the glamorous profession everyone would like you to believe,
Absolutely. Yeah, I mean, a bunch of really great points in that answer, Zach. That was awesome. Now, something else that comes up quite often, it was funny, like a lot of the questions were quite similar. Like we seem to be able to group them fairly well. And one of those questions was, what do you do if you're a young trader with limited capital and or limited time? So what are some of the first steps that a new trader should do who has, a lack of resources and time in terms of like time and capital?
You can pay the tuition of the market in either time or money. You got to pay one. If you don't have money, time is your only option. And so I think you have to make a decision about benefiting future you instead of present you. You have to stop thinking about how am I going to learn this really quickly and start making $1,000 a day with my $2,000 account, and it's just unrealistic. You have to plan for success later. Someone I think once told me it's like easy achievement is the achievement you can get right now. It's winning in a video game or betting on a sports match or something like that, right? Hard achievement takes time. That's why it's hard. You do the things that suck, that are difficult, that other people aren't going to do. This goes back to, if you're not working on your edge, someone else is. There are people who will get up at the crack of dawn and work all day, later than you'll, stay at the office later than you will. The best you can do is to try and catch up to them. I don't mean you got to put in a ton of time. I mean, this is, I think, the freedom that a lot of traders are seeking. They think they're seeking financial freedom. They're looking for flexibility freedom. They're looking for the ability to be a father, to be a husband, to be a friend, to work part-time and trade part-time and not be consumed by this. That's the flexibility. That's the freedom that we are all aspiring to. And I mean, some people I can understand. It's really just a limitation of capital. Once they have more money, they'll feel more free. They can take more time. Like, okay, great. I think it's about if I'm going to be a trader, how am I going to maintain my life? We were joking about having a personal life. It really is important to have balance in all things. I don't think I traded any better during those 20-hour days and the all-nighter, kind of like trading futures overnight, and then you do a full session of equities, and then you trade another session of futures or equities, and then futures, and then equities. It doesn't make you trade better. It's not like you get paid hourly for being in the market. I mean, this is a common misconception, right? People tell you, oh, you're a trader, you must make money. It's like, yeah, nobody pays me. I make money if I'm good. I don't get paid for showing up. You know what I mean? That's why you see a lot of guys with no edge just sort of gambling. They're trading for the present. If they win, hey, right? And if not, oh, well. This is as good as it's going to get for them. It's like if a coin flip, if 50-50 was the best the odds would ever be for you, once the odds became 50-50, you'd be like, all right, let's do it. Let's go. This is no better than, no worse than any other shot. For those of us who aspire to have longevity in our careers, we have to figure out how to survive to trade the next day. It's not about making money today. It's about making it to the next day. We as humans, you remember what you're saying, like, it's like, I've been doing this long enough, I'd be embarrassed if I were bad at it. It's like, I feel like you acquire through osmosis, if nothing else, as you last longer and longer in trading, more and more things. There aren't the kind of epiphanies, the eureka moments, the breakthroughs as there are early on in trading. But that's because you're more experienced, right? It's a more nuanced lesson that you may be learning. Maybe it's more of a lesson about yourself rather than a realization of like, oh, so you mean when I go short, I'm betting on the downside? Oh, it's like those kind of initial awakenings you have when you're a trader and you go, I get it. So you can bet on both directions in the market. Huh, how about that? It's not, you're not going to have those massive awakenings later in your trading career, but you are going to continue to develop to the point that if you make it a year in trading, I mean, like, people should respect not the 20-something-year-old fund managers, the hot hands. You should respect the guys who have been in this business for 40 or 50 years. Longevity is what's to be respected. And I'm serious because I'm a 29-year-old hotshot trying to convince you that I'm the one to be listened to. Now, I really have tremendous respect for people who have transitioned across multiple market shocks, multiple market regimes, different bull and bear cycles, different presidents, different just different regimes. It's just incredible when you think about how much they've seen. It's like when you look at a 300-year-old tree and you're like, oh, the stories that tree must be able to tell. Can you imagine a trader who's been in the market for 50 years? I think they'd tell you that everything we're seeing today, it's happened before and it will happen again. Actually, this goes back to the earlier question about structuring your study when you start out. Reading Reminiscences of a Stock Operator, the kind of semi-fictional account of Jesse Livermore, that really struck me because it made me realize, like, everything that I'm experiencing, this guy experienced 100 years ago with none of the technology. And he put, great phrasing, very elegant way of saying, some of the things that we are still experiencing, that we traders are still struggling with. So the best way is through experience. And that experience, fortunately, can be approximated with simulated trading. Like, anybody who tells you that sim trading is entirely useless probably owns or works at a brokerage firm. They want you to trade because they get paid by your commissions. And so, of course, they're going to call bullshit on sim trading. I mean, look, it's obvious that it lacks the gravitas of real money. I mean, I think that should be obvious if you're just now realizing that, like, simulated trading probably doesn't have the same emotional impact. Maybe trading's not for you. But, like, I've seen students get emotional about sim trading before during a session. Like, then again, I've seen people lose their minds over way stupider stuff than just, the market and simulated trading. You can accrue the experience of technical analysis, of risk management, of juggling multiple trades at the same time. You can get a lot of this experience without risking any money, but you do have to commit time. If you don't want to commit time, go ahead, put $50,000 into an account, start trading. You will learn a lot of lessons, and they will be expensive lessons, my friend. It's almost like the difference between at a university, they allow you to audit a course where you can literally just attend. You don't get credit for the course necessarily, but you still get the information, you get the experience. Right now, when you're not a trader, when you're an aspiring trader or an early stage developing trader, give up on getting credit for the course. You just got to go sit in and see if this is all gibberish to you or if it's something that really resonates. What if you found that trading's not for you? Thank goodness you didn't put real money down. And what if you found that trading really is for you? Oh my God, then that's awesome. I mean, you figured out that you're really good at something that can make you thousands of dollars. Either outcome is going to be a positive. So,
yeah, and I'd just like to add on to that. I mean, like, I don't think that having a lack of capital is, I don't think that really holds any water. Like, I think that shouldn't act as a barrier, and it shouldn't stop you getting into trading, because you have so much to learn before you should even consider putting some real money on the line, that, having a lack of capital right now should be maybe one of the least of your worries when first getting into trading.
A common thing I hear is, Zach, if I just had $1 million, then I would trade so much better. I'd have enough money to trade a bunch of positions at the same time. I wouldn't be limited in my sizing. I could scale in, scale out. I could blah blah blah. You know what I say is no. You'd be the same crappy trader that you are now. You just have $1 million. You have more money, right? You wouldn't like become a different person because you're well capitalized. You got to respect that, like learning to trade with 100 shares or 100,000 shares with some obvious differences, impact on the market, execution, approach, and strategy, right? But like you're making the same essential decision. Is this market likely to go higher? If so, then I need to find a way of getting involved in a risk appropriate fashion. There is no excuse anymore. If this were 20 years ago where there wasn't, simulated trading technology, I know I want to say like market replay. I want to say backtest broker. Thinkorswim has a great feature on demand. I use this with my students all the time. Once they've learned the VWAP trading methodology, we can like replay a trading day in like fast forward. So we can fit a couple trading days into one session, kind of like sit side by side and like tag team the market. We can watch the same simulated day at the same speed, kind of in lockstep. It is incredible the opportunities that this has afforded people. I have traders in different parts of the world or who are working during market hours, and so they would never otherwise be able to trade a real account or even a simulated account. Something like on demand is awesome because they can trade in the middle of the night. They can trade, in their spare time whenever it's convenient for them. I think that's a great way of saying it, Aaron. There is no excuse anymore.
Yeah, absolutely. I mean, I obviously fully agree with that. So in your journey to becoming a profitable trader, would you say that you attribute your success to a few moments and milestones, or was it something gradual and rather the accumulation of many small victories?
I mean, I definitely had the moments. I definitely had the milestones. I think it's like a series of important firsts would be a good way of phrasing it, like your first $1,000 day. And not that, I mean, look, it's more about percentage than dollar, but like everybody dreams of making $1,000 in a day, right? I mean, every trader listening to this podcast has thought about like, oh man, wouldn't that be a cool like level to break? My first week with 5 profitable days, I felt really good after that. Like your first successful short trade, your first, you know what I mean? There are also negative milestones. First time you've been stuck in a halted company. First time you've filled like way below the market due to illiquidity. Like, you've been stopped out and you get at the worst price of the entire day. And you're like, you lost $600 in the blink of an eye just because of a market stop. First time you stay up all night reading Seeking Alpha because you're stuck in a shitty position and you're terrified. Believe me, you have not been a trader until you have freaked out up all night trying to read what other idiots who are stuck in the position are doing and thinking. And when you're just desperate, you are voracious for knowledge. I mean, this brings me back to like the earlier answer about being on the blogs and in the chat rooms, and like, God, that takes me back. That feeling of like not knowing what the outcome is. And I think this is the difference between like having a system and not having a system. You still won't know the outcome, but you'll know what outcomes you're choosing between, or which 2 outcomes may occur. You'll know what a win looks like, and you'll know what a loss looks like. As opposed to when you don't have a system or an approach, you're terrified. I mean, you could wake up the next day and the stock just drops. And what do you do? Where's your stop? What's your plan? What's your thesis? And I had none of that early on. So I mean, I think about those milestones, those kind of moments that stick out. The gradual stuff, look, you eventually have to get fed up with it. Okay, here we go. It's sort of like when you grow up with your nutrition. You kind of turn into an adult and say, all right, I gotta have some vegetables. Like I've eaten nothing but Pringles and soda for the last 20 years of my life. It's time to maybe give my body something better. You get more mature about what you put in to your to your trading brain. Are you reading the same annoying guys on Twitter who you just think are funny? They may not be very insightful, but whatever. Are you listening to the same market recap just because that's what you've always listened to? Okay, I don't know this guy, so I'm gonna talk a little shit. What's his name? Oscar Carboni. He's a guy who does like market recap videos. I remember watching him back in like 2008, 2009, and it was just like a habit. It was just a thing that I watched because when I started. And I caught myself like a year into trading. I was still watching those videos. They didn't give me any information whatsoever, but it was just habit. It was part of my routine. And it's almost like a bad habit that I had picked up. You need to start asking yourself, what are the bad habits? Who are the useless traders that I talk to, that I commiserate with, just because we're buddies? It doesn't mean you can't talk to them, but stop comparing notes about the next day. They're probably not that useful anyway. Find someone who you really genuinely admire their work ethic and ask if you can just sit silently with them on Skype and listen to them, go through their prep or something. Be a sponge. You know what I mean? That's what's going to help you with the sort of gradual wins rather than the massive milestone. Like, look, obviously I'm going to say something like, well, when I first found VWAP, that really clicked with me. But even that, it took me a while to really appreciate what I had. I thought it was just another indicator. I'd become so jaded with all of the other indicators and being told, well, all you have to do is use a fast stochastic. That's the key. Or, whatever someone else has told you is going to work and it's just designed to make you feel better. You know what I mean? There will be those breakpoints, those kind of aha moments, the eureka, the epiphany. But they're few and far between. And like I said, they get fewer and fewer as you go on in trading. It's just refining a process and not screwing up the results. Your results should reflect more of your system than your personality. You know what I mean? It's like it should be more about your design, your plotting of the course, rather than, oh, well, I grabbed the steering wheel and turned the car at the last minute and I screwed this up. It's like, don't make discretionary mistakes. Make systematic mistakes if you're going to make them. Make something that you can evaluate and then learn from and then change, rather than, oh, well, I got nervous at the very last second and then I stopped out. You know what I mean? That's shooting from the hip. That's undisciplined behavior. You may not be a robot, but my God, you can be a more disciplined human. You can be a more mechanical human, let's say, right?
Yeah, I really like that answer. That's excellent. And I also really like this question that someone sent in. I think this is spot on. They say, rather than what did you do to become profitable, what did you stop doing to become profitable? I think it probably leads on from that last question a little bit, but yeah.
So I noticed that losing trades was really negatively impacting my profitability. So just by eliminating losers from my trading record entirely, that no, I'm messing around. Obviously, that's like somebody telling, well, I learned the secret was to buy low, and then this is the key, to sell high. Actually, no. Sincere answer. What did I stop doing? I stopped trying to get a better price. I was always that guy who I would see the setup and I would say to myself, just 2 more cents, just 2 more pennies. Cause that's, if I'm trading 300 shares, it's going to be $6. That'll cover commissions or something. I'd rationalize to myself, just a little more, just a little more, just a little more. And that's like, that's poking the bear a little bit. That's like, it's like, pushing someone's buttons. You're messing with them a little bit, but you're just pushing them to see how far they'll go. Eventually, the stock is going to take off and move without you. And you're going to be like, damn it, I missed it, because I was trying to get that, that best price. And same with the exit. The Jesse Livermore quote is, the most expensive eighth is the first eighth and the last eighth. And of course, that's like when stocks were still trading in eighths. So the first tick and the last tick, or the first penny and the last penny. I've seen so many traders ride a terrible position, not off into the sunset, but what's the opposite? Like off into the abyss, directly into the sun, right? They ride it into hell because they didn't give up on the position when it came back to break even. They said, well, what about 5 cents above break even? That'll cover commissions. And it's almost like penny wise, pound foolish, right? That's a common mistake. When you see a setup, your job is to get in the trade in a risk-appropriate fashion. That doesn't mean, just buy it willy-nilly, sort of like wherever. But it definitely means be more humble about being perfect. You're not going to be perfect. You're not. No offense, but you're listening to a podcast with other traders talking about how to be perfect. You are not perfect. you listener of the podcast right now, probably not perfect. Truth be told, Aaron and I also very much not perfect. I think you guys have realized that by now. But giving up on perfection. This kind of goes back to like what I said in the ebook, right? Stop trying to prove it to your girlfriend, to your family, to your trader friends that you're an awesome trader. Just dissociate from the identity of being a trader. Give up on proving to others or bragging about it, or it's all fluff. It's just the fluff that we fill ourselves up with before we make the leap to the more nutritious kind of substantive meals for our trading brain, right? Here's another one. I mean, this applies to what you're doing with coding and quantitative trading. I stopped expecting one system to encompass the entire market. So early on, this particularly in my trading career, my coding career within trading, I was trying to make one system to rule them all, like one system to fit all. And I realize now that markets that are going through different regimes are like different weather. You've got to dress differently. Yeah, it's all outdoors, but it's cold outdoors or sunny outdoors or windy outdoors or rainy outdoors. They're very different styles of just going outdoors. It's not quite that simple. It's not so simple to be able to say, well, I'll code something to reflect every different outcome within the market. There are too many different permutations. The best you can do is build, like think about like building a trap. You can't build one trap to catch every animal out there that you're trying to trap. You have to build different traps for squirrels or for a fox or for a wild hog, or I don't know, what are other people trap? I'm not much of a hunter, but you know what I'm saying, right? You have to build different traps for the different creature you're trying to pursue. Similarly, for different setups, there's a totally different system. And how nice and flexible it is. It's like giving, instead of one single system, one equation to fit them all, you kind of let the system flex to, encompass the entirety of the market. The up days, the down days, the sideways days, the up days that become down days, the up days that become sideways days, and vice versa, and every permutation of that. No one system is gonna kill them all. And I'll tell you, if you do come up with that system, the one system that works for everything, please give me a call. I'll leave my email address at the end because I'll buy it from you. I'm kidding, of course. It's the holy grail. Yeah. I mean, that is a really great question because it talks about not just what is the secret to trading, but what do traders do thinking that they're doing it right. It's like driving through a skid in a car. Sometimes you're oversteering, you're overcorrecting. It's like you're doing too much. I often teach people, like, when you get in a good trend trade, your job is to go into a coma. It's to forget that you're in that trade. If you're in a trend, think about it. Literally, it's probably moving in your favor. Check back in on it. Wake up every now and then. But, you can kind of forget that you have to watch it like a hawk. You don't need to be so intent on every candle matters. Not every candle is created equally. Not every candle matters. And therefore, you kind of need to be an overseer of different systems, of different setups, of different price patterns. You have to be a manager of trades, not a trader. I know that sounds weird. I mean, that's okay. There we go. Another title for my book, right? Don't Be a Trader by Zach Hurwitz. You know what I mean? Wouldn't that be a great name for a book about trading? Don't be a trader. Anyway, all right. Sorry, long-winded answer.
No, that's awesome. That's really good. So this one here is kind of like a two-part question, I guess. So when is the right time to seek out a mentor or some sort of education? And how does one go about selecting a mentor from all the folks out there offering their services? Like, how can they drill down on one that's right for them?
That's a good question. Trying to think of when's the definition point of when you plateau. That's a good open-ended answer. When you reach a point of absence of development, where you're not getting worse, but you're just not getting better. That's usually when people seek out trading education. Whenever there's and there are multiple plateaus throughout the trading kind of trajectory, if you will. When you go from an aspiring trader to a novice trader, then you kind of flatline for a while, start making some breakthroughs, really get into where you're being realistic about risk management and having to be disciplined and consistent. Then you become an intermediate trader. Then you plateau for another couple months or a year. At each break point, that's usually when people will want to say, even if I can't get there right now, what do I need to be doing to get closer or, headed more in that direction? Honestly, something I see a lot, and I've kept abreast of a lot of the sort of trading education out there, for obvious reasons, as I'm a trading educator myself. Like, you want to find somebody who's a good trader, but you really want to find somebody who's a great teacher. And everybody's focused on like finding a good trader. They can be a millionaire and the worst communicator. They could be totally unrelatable. They could be kind of a dick. It doesn't help you, right? Like, seeing excellence is not as helpful as you think. You remember what I was saying about like working in a recording studio? Like, the pros make it look easy. You watch Jimi Hendrix play a solo and it just looks like what he is born to do. You watch some idiot try and like half-ass their way through, a Jimi Hendrix solo. Like, you're going to see, oh, wow, look, he's not tuned correctly. He bent that note, a couple cents off the right note. I can see here. You can see so much more from I don't know how else to say it, from somebody who is ready to be a good communicator and connect, I guess, what the elements of good trading are, rather than just, hey, watch me do it. I can show you. It's not always that simple. They have to be the right type of teacher, not just the right type of trader. I think for a lot of these guys, no names, right? But they're just marketers. They're entertainers. I think for them, teaching is a chore. You obviously want to find somebody who, I don't want to say is going to put up with you, but who it's not a chore for them. You want to find somebody who's like really all about teaching traders and is going to be understanding with wherever you are as a trader. They're not going to be frustrated that you're not moving faster, or that you are moving quickly. Some people will say, oh, but you got to go through my entire course offering. It's like, well, but what if I'm picking up on it more quickly, dude? I don't need that much education. You want to find somebody who's going to fit to your speed. I mean, the same way that we talk about finding a trading style that fits to your personality. I think it reaffirms the foundation of my own trading and system, and it challenges me to reproduce it. Like, that's what I like about being kind of a mentor or an educator. I think when it comes down to it, you should be treated as an intelligent trader who wants to improve, not like a radio receiver for their marketing campaign. That is a huge distinction. And I only say that because there are so many people who are just marketers. On the flip side of that, I love it when you can see somebody who is so genuine and psyched about talking about trading. Like you mentioned Dan Shapiro. He's awesome. I know him from my Sanglushi days. He immediately comes to mind. You can just tell that guy like eats, breathes, like sleeps and shits trading. You know what I mean? Yeah. As far as selecting someone from everyone who's out there, look for somebody who's also willing to, take a little bit of time listening to you, because it's really not about you having to pick up on everything. It's about the mentor finding, what's the recipe for success for you. Whether it's deductive or inductive learner, whether it's visual or experiential, or auditory, right? You like listening to people talk about it. Different styles of learning. I wish I had been an English teacher for a couple of years. I think it would have made me an even better coach. But just, learning about the different styles of student that you're going to get. You want to find a coach who's going to pay attention to that. I think it's also worth saying, just so people know, I'm not talking my own book. Guys, there are thousands of great trading educators out there. There are a lot of people who aren't actual trading coaches, but who are going to be great trading allies. There are people out there, probably some great unknowns that I hope Aaron's going to have on between, episode 50 and 75 or 50 and 100, who you'll probably hear from. Find somebody who resonates with you, who when you hear someone talk, you say, I could listen to that guy talk about this for hours. And obviously, I guess we're like almost 2 hours into the podcast. If you're bored with us talking right now, then don't seek us out for education. No, I'm just messing around. But find somebody who you feel like you could hang out with, who you could talk with. Somebody who is both entertaining and relatable. Certainly that's important, but a really good teacher and a good communicator.
Yeah, well said, Zach. Emotions is a big one, right? So we hear it all the time. Do you really feel almost no emotion with a systems-based approach? I mean, this is kind of maybe a common myth that some people might have the wrong perception on. I mean, even with a strategy to trade, you must get frustrated at times, right? Would you be able to expand on this a little bit?
Oh man. Yeah, I still get frustrated. I still get frustrated a lot. And those of you who know me know that I like to like preach this kind of easygoing, even-keeled attitude. Like, look, everybody's going to get pissed. You're going to get frustrated that you're emphasizing the wrong system on the wrong type of day. So even the system's doing all the work for trading and identifying the trades and managing them, but you're emphasizing or paying more attention to the wrong type of system. There are days that I'm very upset at myself. But okay, you can't eliminate risk. You can minimize it. You can't eliminate fear. You can manage it. That way you're going to have like strategic regrets. You're not going to have tactical regrets. This is the whole like I'd rather run aground because I charted the course incorrectly than because I like tried to steer the ship or the car or whatever, on a whim. That makes me feel dumb when I try and act on my trading plan and actively screw it up. That's when I beat myself up. That's when the poisonous self-talk. That's when like the bile and the poison Zach comes back out. All systems lose money. Great systems lose less. So think about that. All systems are going to have terrible days. They're going to make 10 losing trades in a row. You're going to doubt yourself. You're going to doubt that you were ever a good trader. You're going to doubt that the data is right. Oh my God, you're going to doubt everything. And then you're going to get over it. You're going to get over the doubt and disillusionment and disbelief and frustration. And I think I read somewhere about like, eventually you're going to get over all this bullshit and it's going to be worth it. And that really stuck with me. It's true. You're going to find little things that you say, I may not be a genius, but I know what a bull flag looks like, and this is a bull flag. And then it breaks outward and upward of the bull flag, and you're long, and you're saying, hey, I may not be the best, but I'm learning. I'm getting better. You got to take the small victories and remind yourself for every time, like I say this all the time, it's almost like if you take the cow, you deserve the milk. So that's like the old phrase, if you want the milk, you got to take the cow. Like if you want the upside, you got to take the downside. If you are going to hold yourself accountable for all the failures, you deserve a little bit of the patting yourself on the back when you do it right. Like this isn't all luck when you do it right, and it's all your fault when you do it wrong. So I try and remind myself, what's one thing that I've done right today? What's a good trade what's a good read that I had? Where did I dodge a really shitty trade? Actually, it's really funny. So we talk about how like trading and life work together. This is a good strategy for a fight. If you're fighting with your girlfriend or your significant other, just say, honey, just say one nice thing about me. I'm going to say one nice thing about you. Let's just remind ourselves that we actually like each other. You know what I mean? Like when you're deep in a fight. Similarly, you got to you're not accountable to anyone else in trading. You have to be both your supervisor. You have to bear down on yourself, and you have to indulge and kind of remind yourself you're a good person, you're a good trader, and you're going to make it. You have to be both the superego and the id, as I think I've said in prior interviews. If it's a trading plan that you don't have to trust yourself to follow because it's a system, like there is no alternative, that's a trading plan that I could follow. Like, remember that I'm a human being. I'm going to have days where I want to click the mouse more than the system says I should. There are days where I'm going to get nervous and want to stop out of a trade. One of my trader friends runs a stopless reversionary system, and he's like, oh man, was that a wake-up call? Some days where I'm looking at these trades and they are just crushing me. But I realize this is a statistically profitable event, and it may not work this time, but it's part of my plan. I'm trading small enough risk to where even if this totally botches me, it totally screws me, I'm still a small loss. I can afford to take this loss because it's within my plan. Losses that are outside of my plan, like that's when I start, that's what tilts me so hard when I make mistakes that are outside of my plan, right? If I can have losing trades, that's not a mistake. A mistake is when I deviate from the path.
Okay, sure. That's excellent. Now, Zach, we had a few questions that came in around scanning. I know we've still got a bit to get through, so I'm going to try and merge these together. How do you go about finding setups that meet your criteria? What tools do you use and what tools are helpful for you? And are there certain filters that you find are really good at narrowing down a long list of stocks?
Yeah, well, there's quite a few products that you can use. The products that I have used in the past. So I've used my brokerage platform, Thinkorswim, but almost every brokerage has some sort of good basic scanning or filtering feature. Finviz.com, Finviz.com. I'm sure everybody knows about that. There is like the third-party alerts program that I use. Anybody who's more interested in hearing about that, obviously shoot me an email, tradingcoachz@gmail. Happy to tell you more about that. When it comes down to like what filters or what do you use, you got to make it more general. I don't think there's like any one set of filters. It's not like you can look for a certain grouping of stocks and that's the grouping you should be looking for. It's different, obviously, for every trading style. If you think generically about scanning, I always pare it down into like there's 3 layers to scanning. There's like universals. These are things that are true at the very beginning of the trading day. Like it's a U.S. domestic stock. It's closing over $10 a share. It's got 1 million shares on average over the last 20 days. I'm just making this up, but these are like universals, things that are universally true that make up the realm of potential, candidates for you. Then there's conditions, which is the next, nuanced layer, which is sort of things that must already be true but can change throughout the day. It's, let's say, above a VWAP. Its RSI is below 20. I'm making these up. Just conditions, things that must already be true. And then finally, there's triggers, elements about the setup that when they hit, like that's when you want to know about the trade. That's the shortest term, the most responsive aspect of all 3. So universals, conditions, and triggers. And you start realizing like what sophistication with which you're scanning the market based on, am I doing more universals? Because if I am, I'm probably on finviz.com. I'm probably doing like a daily level filter for what meets my broad criteria. If I'm doing conditions, I'm trying to filter down even further from the 1,000 stocks I could trade into maybe the 100 stocks that I might want to trade today. And then triggers, which is what I'm using, record for me the exact moment that all of my criteria were met. And if I were a perfect robot, I would have taken this trade. That's when it gets into like triggers. What is the actual event? What is the aspect, the facet that changes ever so slightly, and that's the trigger to get into the trade? I know a lot of like people are going to want me to give some like actual answer to this. Some common ones that I hear in terms of filters that I would agree with, so things that I either use or other traders I know use. Average volume versus current volume. So you can think of this like volume normalized or relative volume or like a volume multiple. I've heard all of these phrases before. What is today's volume versus the average historical? Because you can quickly get a sense like, wait, we're trading 3 times the average day's volume and it's like 11 o'clock in the morning. Oh my God, that's a heavily traded stock for the day. Kind of gives you an idea of where participation is surging. I personally track things like standard deviation width, just because that to me is a measurement of like relative opportunity, how much width there is on a chart for me to capture. And for every chart, every trader, it's going to be different on every chart. Some traders watch average true range, ADX, a measure of kind of trendingness of a stock, the average directional index. These are just the kind of common ones that I've seen across many different traders that seem to be helpful. None of these are the triggers. These are more like conditions or universals. Triggers are obviously up to each trader to decide where am I on that spectrum of like responsive or credible. Am I trying to be more responsive where I get a lot of signals, but a lot of the signals are kind of crappy? Or am I willing to wait for a confirmation? I'm going to be patient. I'm going to get a worse price than the responsive guy, but I'm going to make absolutely sure that I'm getting, a confirmed signal. There are trade-offs to each one, of course, and there's no right answer, but I hate to say that. I wish there was a right answer. It's like, oh yeah, you just got to pick a responsive. Just don't worry about being credible. Just get a bunch of signals. You're going to be fine.
Yeah, well, I mean, I really liked how you explained those three layers. I think that's really helpful in terms of how to think about approaching the scanning process. I think universals, conditions, triggers, I think that's spot on. That's really good.
And if there's anybody, I know I'm doing a dangerous thing. I already did one dangerous thing in this podcast, telling 10,000 people that I used to listen to Creed. But if you have questions about the scanning process, if you're curious about how to scan better, how to do better, what I use, anything more about this, sincerely, shoot me an email. Right? I mean, this is what I'm here for. This is what other traders are here for. I'm eager to talk to people who are going through this, especially if you can write it out in bullet points. It's almost like there's an old traderism of, if you can write it logically, then it can be coded. If it can be coded, it can be back-tested. If it can be back-tested, it can be vetted. And if it's vetted, then my God, you've got a good system. Go trade that with confidence. And if not, if it's crap, well, thank goodness, you've just dodged a bullet, right? You were almost trading this really crappy system. So start with that logical outlining. Write it in plain English. I really mean this. In the emails that I'm going to be getting, I really hope there's a lot of bullet points and bonus points, extra credit for you guys if you use universals, conditions, and triggers. Because I think it's a good way of organizing, sort of like, where do I stand? Am I doing like zoomed out filtering, or am I doing really microscopic, zoomed in analysis and searching?
Okay, excellent. Now, there's obviously a bunch of questions we received around VWAP. Okay, people know you as the VWAP guy.
What's VWAP? I'm not familiar with that, Aaron.
Well, let's tackle that. So for anyone who might have maybe forgotten or isn't really familiar with VWAP, let's just give us a quick overview of how you incorporate VWAP into your trading.
All right, this is going to be a challenge, right? For anybody who knows me, you know how talkative I am. I'm sure you can tell on this podcast already, so I'll try and be swift. VWAP is a more accurate, honest average price. It's a benchmark line that institutional traders have used for decades. It moves proportionally more or less to reflect the current bar's volume as a function of the day's total volume. So like simply put, if there's high volume, there's more impact on the average. If there's low volume, there's very little impact on the average. It starts every day at the beginning of the market. It resets at market close. So it's giving you a day's cumulative average price. There's no periodicity to it. VWAP kind of reflects the democracy of the market more accurately, I like to say. It's like one vote per share, not one vote per trader. So there's a lot of, shares maybe to one trader, and therefore that trader gets to vote many more times in this hypothetical democracy. It's like the Animal Farm quote from George Orwell, one of my favorite authors. All animals are created equal, but some animals are more equal than others. It's kind of ridiculous double speak, but seriously, like some traders are more important than others. We kind of have to admit that. And so we more accurately reflect that democracy by affording more significance to the bigger volume bars and therefore to the bigger traders. We all know, we intuitively, we know that the big traders move the market. So why shouldn't we account for that with our technical analysis? And the institutions use it literally every day. And I mean that literally every day to determine where and sort of how aggressively to enter or exit their positions. I think it's about time that retail traders understood the market around us a little bit better. I think VWAP is a first but huge step for many traders that I speak with. I would say you don't need much preparation or nightly research. There's no need to watch the news or read the tape. It's pattern-based. I've made the strategy very visual, color-coded, easy to learn. I think it's all about what are the big traders using to enter or exit a trade. And the answer is often a VWAP-based execution assist algorithm, sometimes called like a guaranteed VWAP order. And that may be a big mouthful, but it's basically, haven't you ever wondered what the institutional traders are watching? Haven't you ever kind of considered that maybe there's something else out there? And that's volume weighted average price. I was lucky enough to have learned about it in my own retail trading career, Okay,
so VWAP's quite commonly used on an intraday time frame.
Mm-hmm.
Are there variations of the VWAP strategy to account for maybe different markets or different time frames? Could you share with us a little bit more about that?
Yeah, absolutely. I have been a productive, busy little beaver in the coding world. I've created like a dozen custom indicators. I created them not only while I myself was developing my own VWAP approach, but afterwards, as I had more and more students who would request, hey man, could you visualize this for me? Or could you put a label on my charts to tell me when something's happened? So yes, I've created a ton of different sort of variations on VWAP, but I think the philosophy of an intraday VWAP, obviously an intraday market, as I was describing, starts early in the morning, resets at the end of the day. That's the plain vanilla intraday VWAP. Then there's an ongoing, or as I call it, kind of a multi-day VWAP, which is essentially a continuation VWAP over the course of more than one day. It's the same math, but it's applied to 2 days, to 5 days, to 20 days, for example. And this gives us a more intermediate term benchmark. So this is more for swing traders or day traders who are looking at multiple days for context. So I'm a big fan of like a 5-day chart. Tracking these more intermediate term volume weighted average prices give us the same otherwise hidden support and resistance that we look for with a VWAP, but applied to longer and longer time frames. And so people may say like, why, wait a minute, didn't you just tell me that these institutional traders, they care about the intraday VWAP? The key is that the institutional traders are often trading at a much longer time frame than we retail traders. Like we click the mouse and we're in a trade instantaneously or almost instantaneously. If we were trading 100,000 shares or a couple $1 million worth of any given stock, it's going to take us a couple hours to fill. It may even take us multiple days. And so that's where the multi-day VWAP strategy kind of stems from. It also is very intuitive that if something important happens, like a turning point or a tipping point, or what I call like an incident day, we're going to want to know what the definitional line, the average price since a given event. So in the same way we talk about VWAP as being like since the market open, what's the average price? And that's a pretty common question, right? I mean, we all kind of wonder that, what's the average price for the day? But the tools that we had been given is this, periodic moving averages that we had to set. Well, it's 128 bars into the day, and therefore it's 128 bar moving average. That just gets too clunky. And even the plain vanilla VWAP wasn't quite enough. Plain vanilla VWAP and multi-day VWAP. I've created a variety of other indicators, visualizations, and custom watch list columns for Thinkorswim that my traders use. I personally teach 4 trade types for the intraday market, and then multi-day VWAP, which is its own little segment. And that's predominantly for swing traders, like I said, but also for intraday traders who are looking for longer-term support or resistance.
Do you find that VWAP becomes less effective the more you zoom out on a time frame, or does it sort of serve a different purpose? Like you mentioned there, intraday is obviously for day traders, and then the multi-days are more aimed at swing traders or those looking for stronger points of support and resistance. Is it still effective, using a multi-day VWAP? Is that also just as effective or almost as effective as an intraday VWAP?
Sure. So, I mean, categorically, you're going to, just by the nature of the way a VWAP is calculated, as you add more and more volume into the total volume part of the comparison, because you remember a VWAP compares the current bar's volume to the total cumulative since inception. As you get 2, 3, 5, whatever days away from the inception of the VWAP, you're dealing with a larger and larger and larger accumulation of total volume. And so each bar that gets added to the calculation impacts it proportionately less. So sort of like human beings, as we get older, we slow down a little bit. Similarly, we're going to get further and further away from the VWAP the longer of a time frame over which we assess the VWAP. And that's just the nature of the calculation. It is going to get less responsive the longer and longer we take a VWAP over, right? But that's kind of how it should react when you think about it. We're asking for an accumulation of more and more market data. We're trying to encompass uptrends and downtrends, and maybe even if we stretch out to a longer time frame, bull markets and bear markets and totally different regimes. it's really going to be a challenge for a cumulative average price to fit very closely to the market. And so when you zoom out to a longer time frame, that definitely makes a case for other moving averages. But what I've found is when you're looking, particularly in that, I call it the sweet spot between 1 and 5 days, you're dealing with intraday traders or short-term swing traders or people who are trying to execute a trade over the course of, let's say, 2, 3, or 5 days. These, let's say, a large hedge fund or a mutual fund, that they can't trade their entirety of their position in 1 day. You talk to these guys who are managing 20-some billion dollars. They don't make a decision on a whim, right? I mean, they have to go to the investment committee, and then it gets approved and heads back to the execution team, who's actually going to enact the order over the course of the next couple days. Watching a multi-day VWAP has been one of the bigger breakthroughs I've personally had in my own VWAP education, thinking that it was solely intraday, and then kind of realizing, well, it's a natural extension, pun intended, to extend it on into the next day.
Okay, sure. So what markets is it most effective in? Does it work in options markets? What about Forex, futures, or, I mean, you obviously use it in equities predominantly. Sure. Is it just as effective in other markets, or can it even be applied to other markets?
Yeah, so without sounding like a blanket, oh my God, of course, it applies to absolutely everything under the sun. It applies best to equities, best to liquid, large cap, algorithmically controlled equities. I hate to say this, it does not work on that $3 little biotech stock. I should say it doesn't work as well. It probably still applies, but the less granularity you have, so the smaller the price of a stock, the harder it is to really see the type of action that we're looking for on a VWAP. You want to see something that is fluid and mobile and very liquid, and something that other VWAP algos are probably acting on this stock. It definitely applies to futures. I've coached quite a few futures traders in the last 2 months, particularly. It seems like the futures traders came out of the woodwork. Forex, without a centralized volume number, and there is no centralized Forex volume, we can't get a VWAP of like Euro USD, like the pure pair, but we can approximate it by looking at, so for all you Thinkorswim users, /6E would be the Euro futures code. You can use volume weighted average price on the futures proxy, if you will, for the underlying. So you can do that obviously with all the major currencies as they relate to the dollar. So that's kind of a workaround in the meantime. I used to say that this only worked on large cap equities. I realized that, KBIO, among many other, recent sort of momentum names, have shown me that it's really, VWAP works best wherever there's other traders trying to execute orders. And that sounds like pretty much every stock under the sun. So I hate to give a bold, generic, all-encompassing kind of answer like that. I'd be cautious with Forex just because the lack of centralized volume, and you're dealing with a proxy. You're dealing with another contract that's supposed to reflect or relate somewhat of the volume, but it can't really show you the actual volume. As far as options go, because you asked about that too, let me answer that 2 ways. Like, yes, you can chart an option with VWAP, and that's actually something a couple of my students have pointed out to me. They said, I threw an option chart up there, and did you notice some of the same trade types that you taught me are applying here on the option? And that's not obviously rocket science. If they are tied to the underlying, which is the price chart of the stock, and the stock is exhibiting some sort of pattern, option's probably going to reflect that as well. But similarly, yes, the VWAP strategy can be used with carefully chosen strikes and risk tolerances. You just got to be careful you're not going to get destroyed by the Greeks because you're trading a totally technical approach, oblivious to the to the components of the options pricing model. So in that case, you couldn't blame anyone but yourself. You're trading a product designed for risk insurance, like it's a leveraged little vehicle for your trading purposes. It's like using the wrong end of your spoon to eat your cereal. Like, you shouldn't be surprised if that sucks. You're not using it for the way it was designed. You know what I mean? You can't hold the inventor of the spoon accountable if you misuse it. So I'm cautious with options. But yes, it can be done. and certainly anywhere where the underlying, the actual equity, is moving quite clearly according to a VWAP, absolutely, that's where there's no reason not to take that additional leverage, particularly if you are a skilled options trader and you're good at selecting the right strike.
Right. Okay. Yeah. No, that's great. A few people have asked, what are some good VWAP resources? I mean, they're pretty few and far between from what I've seen online, but maybe you could share some insight on that.
Okay, look, I have to plug my own website here because it's literally thevwap.com. I feel like that's a fairly safe bet. If you want to go learn about the VWAP, you might want to check that out. I thought about zachhurwitz.com, but I don't think my name is yet synonymous with VWAP. I'm working on it. Everything else that's out there is literally a quick Google away. So I can't say, oh, you should just check out so-and-so's blog. They've got everything on there. What I've seen on YouTube is literally laughably weak. And I'm even thinking about some of the interviews I've done in the past. I need to, you know what? Okay, how about that? I've got to change that. That's my trader resolution for 2016. My job is to put everyone else talking about VWAP to shame. I got to put so much content out there so that this question never gets asked again. And I say that in obviously a very positive way. I'm not upset. People are frustrated that there's not, better resources for the VWAP. I think everyone will tell you the basics. No one will tell you the nuance, it seems. And that's what I'm trying to change. I mean, I've spent 4.5, 5 years of my life doing nothing but this. I've become a very boring person and an expert trader in this regard. I've sacrificed many hours of being cool in order to be good, because I realize that this is what's going to define me for the next several decades. This is how I'm going to make a name for myself.
Yeah, well, I mean, I think if you can put some more quality resources out there on VWAP, I think many would really appreciate that, and obviously would have somewhere to go to find out more about it, because like I mentioned, it is pretty scarce.
No, you're absolutely right. What I should say, so on the first podcast, on episode 11, first podcast in which I appeared, excuse me, I made the offer of anybody who wants to reach out and talk to me about their trading, or more specifically about VWAP, I will give you a free 30, 60-ish minute consult. That still stands, and I'll let that keep going through, let's say, I don't know, like the 1 year anniversary of that podcast, so like mid-March or something of 2016. Anybody who's still curious about this stuff, like don't go hunting on the internet for it. Just shoot me an email, shoot me a chat. We'll talk about it. I'll answer whatever questions I can for you.
Okay, and what is your email address?
So it's tradingcoachz at Gmail, TradingCoachZ at gmail.com.
All right, good one. Well, awesome offer. I mean, really appreciate it. I'm sure you're going to get a lot of people take you up on that, which is excellent.
Do you remember after that episode, when we were doing the follow-up call, like shortly after we had just like stopped recording, and you were like, do you realize what you've done? Like, do you know what you've just gotten yourself into? Like, I've got thousands of listeners every week, Zach. You're going to be swamped. And I remember being so arrogant as to think, like, oh, come on, like, I'm a nobody. Nobody knows me. Nobody's going to listen to my episode even. Like, I just thought it was cool what you were doing. You and I were kind of buddies early on, and we were like, why not? Well, now here we are. I'm still getting, 10 emails a week or so. But I'm sure it's the same with you. Like when you hear an email from somebody who's like, oh, I love the podcast. It's really uplifted me and kind of kept me going. Like that's what keeps you going, isn't it, Aaron? Like, isn't that partially why you're doing this? It's not just selfish about your own trading. It's about seeing what you can do for others.
Yeah, 100%. I mean, I love to hear that it is beneficial to others as well. And I mean, going off the feedback I get, I think it is. So, and plus, I want to make it bigger and better going forward as well. So always trying to improve. So let's change gears a little bit, keep moving off VWAP there. Exits. Exits was another topic that seemed to pop up a little bit. People kind of seem to feel like there's more emphasis out there on when's a good time to get into the market, like when's a good time to put on a trade. Like trade location seems to be quite big for many people, but where they struggle with is exiting those positions. So what should a trader think about in terms of exits? Like, I know it's going to vary depending on their approach, but what's a good way to think about exits?
I feel like you have to know what type of trader you are. I feel like you have to say before you put the trade on even, I am a scalper. I'm going to take this target. It is short term. It will probably keep going. I will probably want to punch myself in the face, and that's fine because there will be another scalp that I will take. Or I'm a position trader. My job is to, like, this is sort of like what I am, right? I want to hold this for a couple hours. I want to trade it in through the end of the day because if it's trending, it's going to keep rewarding me. Or, I'm looking for a swing entry. I am not going to exit this position today, no matter what. I mean, unless it hits, let's say, my price stop. I'm going to give it a day at least to see how I feel with it before I start adjusting my target or pulling the stop higher. I see traders get into trouble a lot when they put the trade on, the trade looks good, it's going in their favor, and then they go, oh shit, I got to have a plan for this. Wait a minute. But, it's like the roller coaster is already going down the track at that point. And I don't mean necessarily down against them. I just mean it's already happening so quickly. Traders will either get overexcited or, maybe even discouraged if it's not taking on, it's not moving very much. I personally like that approach, by the way. If it's not moving within, let's say, 10 candles, or if it hasn't become profitable by a certain degree within 30, let's say 1 minute candles, within 30 minutes, giving yourself almost like a time stop. What ends up happening is you'll notice, hey, the positions that I sit in for a long time that go nowhere, it's almost like I'm waiting with a ton of exposure, a ton of risk, and no real upside. The trades that I am the most right about, and think about your own trading when you hear this, like, don't they immediately alert you to how freaking awesome they are? They just immediately take off, right? They rally, they pull back and hit support, and then they rally again, and they break to new highs. They're almost unequivocally good trades. They are evident. I mean, I think the same thing about like a trader when you meet them, and I'm sure you've had this, like, your trader friends, you meet somebody and you just are like, wow, that guy is just a positive force for some reason. He's prepared, he's helping others, he's got a good mindset, he's even killed. It's like, I don't know, it takes a lot of inspiration from that. You want to have, like you said about your own episodes, guests. You want to have great clarity of your personality. Who are you and what are you trying to accomplish? Because if you just put it in practice of, I'll put a trade on and figure it out, I think those are the most famous last words in trading. Let's just give it a little room and, or let's just see what happens, and it never ends well. You know what I mean? You have to define your criteria for exit ahead of time. You have to know what type of trader you are. Yeah.
Absolutely. That's really valid advice. So I really appreciate you sharing that, Zach. I'm just looking at the other questions we got on the list here. Psychology, coaching, and that. I think we've pretty much covered all of those throughout our other answers. So,
what, you don't want to talk for another hour and a half? I'm kidding.
I'm hoping we've still got a few people hanging in there listening.
I know. I was going to say to everyone who's made it through another 2 hours of Aaron and I babbling at each other, no, sincerely, thank you. And I got to say, Aaron, on behalf of every one of the 500,000 downloads, really, man, thank you for everything that you do for the trading community. We were just talking about these people who are like a force for good in the world, and I've heard it universally from everyone. I know you have a few haters out there, and I did actually, guys, I tried to get Aaron to let me make him read mean tweets about the podcast, because I think that'd be hilarious, but I don't think we have time. We'll have to save that for maybe episode 75 or something like that.
That'll creep up soon as well.
Aaron, thank you so much for having me on, and keep doing what you're doing, man. I know you've got a few things that you want to say about the plans for the podcast going forward too. I mean, I'm sure people want to know, what are the next 25 or 50 episodes going to be like?
Yeah, so I mean, some of the things that I plan on, what can people expect going forward from this point on? I will be taking on sponsors for the podcast. So they'll be pretty unobtrusive, but hopefully I can get you guys access to some pretty sweet deals. I plan on aligning Chat with Traders with some really reputable and solid brands. I also plan on bringing on some people who might not be your typical traders. So maybe like some Bitcoin traders, people in like alternative markets. I was kind of thinking maybe someone who's like professional in sports betting, someone who's a professional gambler. I don't know if a professional gambler would call themselves a gambler. I'm not sure.
The term sounds bad, but yeah, exactly. Somebody who makes their money by speculating in almost certainly a systematic, very quantified fashion. Yeah.
Yeah, because I think there's lessons that can be learned and applied to trading from those who aren't, directly traders themselves. I mean, Jack Little, who was on the podcast a few weeks back, he was, or still is, a high stakes poker player, as well as a trader. And I found it really interesting to hear about how he views at things like probabilistic outcomes. So yeah, I hope to bring on some guys who are, not your typical traders, just to mix things up and keep things interesting. I want to bring on more guys who fly under the radar, who don't really have much of an online profile. Would be cool to hear from some guys who come from that side of things.
I know that's something that a lot of people would be interested to hear about. There are so many good traders who exist in the periphery of this business. I know we've talked about a couple of, like you were saying, the non-traditional, non-trader guys who might make it onto the podcast. And I know some of the guests that he's planning, guys. I can't say their names. Oh my God, they're so good. You should definitely, keep your ears peeled.
Yeah, and I mean, something that you suggested might be interesting is maybe bringing someone on who might have like the role of like a risk manager at like a prop firm, someone who might not directly trade themselves, but is very active in a trading environment, who could give some good insight from that angle as well. So that's all things to look forward to. Hopefully, have some awesome guests on next year as well. So I can't believe how quick this year's flown by. I can't believe it's episode 50 already. It's been a fast year, that's for sure. So Zach, let's wrap things up here. Where can listeners get in touch with you? So maybe share your Twitter, email, and web address.
Sure. So my Twitter handle is at Zach Hurwitz. That's ZACHHURWIT as in Tom, Z as in Zach. You can get me at email, which is tradingcoachz, all one word, no spaces, at gmail.com. You can also check out my website, thevwap.com, THEVWAP.com. And also I think it's worth mentioning that I'm doing a bit of the coaching work through Chat with Traders. There's just such a phenomenal response. It is kind of, why didn't we do this sooner? And I've met so many good traders already through it. I'm excited for 2016.
Exactly, yeah. Okay, Zach. Well, so obviously Zach's offering the free 30-minute session that you can get with him. If you do decide to go past that, then you can just sign up at chatwithtraders.com/coaching and get a full session with him there, get one-on-one access. Pretty sweet deal. If you guys want to get in touch with me for any reason, Aaron at chatwithtraders.com is my email address. Obviously, the website's chatwithtraders.com. And on Twitter, I try to be pretty active on Twitter at chatwithtraders. So you can reach me through any of those avenues. And guys, if you have any questions for either Zach or myself, maybe we missed something, just go to chatwithtraders.com/50. Scroll to the bottom of the page and just drop a comment or question in the comments area at the bottom of the page. And we'll be monitoring that very closely. Look forward to connecting more. All right, Zach, well, absolute pleasure speaking with you. Thank you very much for coming on. It's really appreciated. It's gone a bit longer than we expected, or kind of did expect, but
yeah.
It's been good, and I hope people have found some value from this discussion. Hope to have you on again very soon.
Absolutely, man. We'll have to talk in 2016 when I'm launching the site and the course. I was just going to say, on behalf of everyone who listens, thank you and congratulations on an awesome 50 episodes and 500,000 downloads. That's sweet, man. That's really impressive.
Much appreciated. Thank you very much.
Cool.
All right, Zach, take care.
You too.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up? Thanks for listening in to episode 51. I have a brilliant guest on the show this week who I can almost guarantee you've never heard of. He generally likes to fly under the radar, but thankfully for us, he did agree to an interview. His name is Bryce Edwards. Bryce is an Australian equities trader. He takes a discretionary approach and makes his money from intraday price movements and goes home flat at the end of each day. During the interview, we walk through the 10 plus years in the build up to Bryce becoming a profitable trader. He's got a really interesting story, and you may even discover it's quite relatable to your own scenario. We also talk about how the order book plays a key role in his trading decisions and how he creates a stocks and play watch list using catalysts such as company news, underlying commodity prices, and broker upgrades and downgrades. Now, if you have any comments or questions for Bryce, just go to chatwithtraders.com/51, scroll to the bottom of the page and drop a line in the comments area. He mentions at the end of the interview, he's more than happy to answer any questions you may have. So I really encourage you to take full advantage of this. All right, well, let's jump to the interview. You're listening to the Chat with Traders podcast. I'm your host, Aaron Fifield, and please welcome my guest for episode 51, Bryce Edwards. Bryce, what's up? How's it going, man?
Good, Aaron. How you been?
I've been all right. Now, the market's just closed. How'd you go today?
Yeah, not too bad. Not too bad. There's been a lot happening on the corporate front in Australia. Big earnings downgrades and big moves in a couple of stocks. So it's been quite a lot of action this week. It's been good.
That's excellent. Nice. Well, Bryce, thanks for agreeing to an interview. I know it's not something that you normally do, but you've got an interesting story, and I think that many listeners will be able to connect with what you have to say. And one of the things I really like about your story is the fact that you didn't nail trading on your very first attempt. So, I mean, you got into trading, you lost some money, you went into property, then you became a stockbroker, and now you're back into trading and you're doing very well for yourself. So we're going to walk through all of this, but let's start right from the beginning. So tell us how you very first got started in trading. I think it was roughly 10 years ago.
Yeah, probably a little bit more actually. So, my interest was originally sparked by my grandfather. So he, was probably more of a long-term investor. I wouldn't say he was overly wealthy. So he was actually a sailmaker. He used to make sails for yachts. And, I'm pretty sure he had a number of wealthy clients who, he'd make sails for. And, I'm sure they gave him tips and advice. And, over that period, I think he did okay. This is sort of, late 90s, early 2000s when, it was pretty easy to do well as a long-term investor. He gave me a pretty small portfolio and, he'd follow stocks in the paper and, tell me what he'd liked. And, I'd end up buying them in an online broking account. So I guess that was my first introduction. That kind of went on for probably 2 years, and then actually went with a mate. My mate's mum somehow got in touch with a guy that ran a seminar, and it was an options trading seminar. So this is a couple of years later, and so we plodded along to this seminar, and it lasted for 4 or 5 days, and that was my first introduction to charting and technical analysis. So it was, I guess, a typical black box system. So the guy had obviously back tested it. All we had to do was follow his system, enter when, one indicator crossed another, and sell when such and such happens, and repeat, and we'd get rich basically. So that was the pitch anyway. But we left the seminar on cloud 9, as you do, talking about which beach we'd be sitting on. While we're trading and making millions, but it didn't exactly pan out like that. So, to be perfectly honest, I don't think I stuck to the system. Originally I sort of just went about trading options willy-nilly, which was, kind of a recipe for disaster. But, I was buying options, so buying puts and calls. I don't think I knew back then that you could be a seller of premium. But I think I started with about $35,000 in my account, and within 6 months I sort of whittled that down to around $20,000 before I gave up. So it was pretty ugly, but considering how green I was, I think and the fact that I was trading options, I think losing less than 50% of my capital was probably a pretty good result.
Yeah, no doubt. So what would you say probably led to you losing not quite half of your account? Like, what kind of mistakes were you doing?
Well, I just had no system. I mean, at the end of the day, I was so new to it that I didn't really understand methodology. I thought it was a prediction game. And, obviously you soon find out that it's not about prediction, it's more about managing risk. That was, that was a pretty big loss for me. I think I was 20 or 21 at the time. And, I thought, this is a mug's game. It's for the professionals. I'm not going to make any money from this. So I threw the towel in on the stock market, and I ended up getting interested in property. So, I focused on that for about 5 years, I think. So I actually ended up buying a couple of places in New Zealand. Have you I sense a bit of a Kiwi accent there? Is that right?
Yeah, I'm from New Zealand. I moved over to Australia when I was 12.
There you go.
Yeah.
So I bought a couple of places over there, and that was, I held them for about 5 years, and then the financial crisis hit, and that was sort of 2008. And at that time, I was really interested in what was happening on a macro level. So at the time I was working as a mortgage broker, and that kind of complemented the whole property investment thing. And so I had a pretty good understanding of the whole subprime crisis. The securitization of mortgages. I think I sort of, recognised that they were, bundling up steaming piles of what and selling it on to unsuspecting investors. And at that time, I'd actually discovered the likes of Zero Hedge and people like Peter Schiff and Mark Faber, and I got really interested in the whole Austrian economics crowd. And that sort of led me to be turned into a kind of Chicken Little type character. I thought the sky was falling in, basically. I thought the US dollar was going to collapse, and I quit my mortgage broking job and sold my investment properties, and put all my money into an account to try for a second time to be a full-time trader. It was a really, really fascinating time to be in the markets. But again, I hadn't really done the research, and there wasn't any method to my trading. I didn't have any discipline, or risk management. So, all I had was a pretty strong view that the world was going to hell, and I thought that I could pretty much short everything and be long gold and make money. And, it didn't quite pan out like that. So I think, after the first QE program was announced, I had some pretty big wins in gold stocks. But, because I was so bearish, I kept trying to short things like consumer discretionary stocks. And, this is through that 2009 rally. And I just basically tore up all the profits. So, I was shorting really strong stocks in a bull market, which, was a bit of a recipe for disaster. So, shorting things like Flight Centre, What else? I think I had a go at JB Hi-Fi, and even in the US, I tried shorting a couple of names. I remember I took a pretty big loss in Whirlpool, so that was WHR on the New York Stock Exchange. So yeah, I mean, the end result was no method, poor risk management. I was gambling. So that went on for, I had quite a bit of money in the account, so I think it went on for almost 1.5 years. And, if it wasn't for a certain turn of events that stopped me trading, and that is my broker actually collapsed and my trading account was frozen, if that hadn't happened, I probably would have gone about blowing myself up over the course of the next couple of years anyway.
Okay. So, wow, there's a lot to take in there. So let me just ask before we move on, how did you go in property? I mean, did you have, quite decent success there? And is that what allowed you to fund your larger size trading accounts?
Yeah, well, I mean, at that time, there was a whole lot of literature out there about positive cash flow properties. So that's what I was trying to do, buy properties that generated a rental yield in excess of the cost to finance. And so, there was guys going out there and just, borrowing and buying and borrowing and buying. And because of the cash flow that was being generated, then you could just keep buying stuff. So, yeah, I mean, that's what took me to New Zealand. I mean, I don't know whether you know a town by the name of Taumarunui, but I mean, I bought a couple of houses over there for less than 40 grand, on a 16% yield. And, within a couple of years, 3 years or whatever, they'd tripled. So it was just right time, right place, I think, more than anything.
Yeah, no, that's an awesome return. Okay, so I'm not sure where this fits in on your timeline, but you got a job as a stockbroker. So what was this experience like for you? I mean, did you learn anything significant in this role? Tell us a little bit about, being a stockbroker.
Yeah, sure. Well, I mean, how I actually got into it, I mean, obviously after this broker went under, and, I won't mention the name of the firm, but they're actually based on the Gold Coast, which, in hindsight was probably a bit of a red flag. But, I mean, the end result, I ended up losing a couple of $100,000. So I was devastated. And, that was a pretty heavy weight on my shoulders for a number of years there. But the end result was that, I hadn't had a job for probably a year and a half. I didn't really have any money aside from what I'd lost in the trading account. I didn't have an income. So, I had to go back into the workforce, and, I had a passion for the market. So obviously thought that getting into stockbroking was a pretty good idea. So, the first 2 years was, really all sales, so cold calling, bringing on new clients, and then eventually, probably in the third year, I worked for a number of different brokers, but in the third year, I eventually had my own book of clients. So some would obviously trade their own accounts, and, to me, they were the best kind of clients because, you could kind of just sit back and they would generate commission. But then there was others that were really looking for more general advice, stock advice, and I'd present them with trade ideas and obviously execute on their behalf.
Okay, so how were you generating those trade ideas for them? Like, were you obviously heavily involved in research during that period?
Yeah, that's right. Obviously after 2 years, I went and got all the qualifications, and by the time I had my own clients, I'd finally got around to doing the research on trading methodology and risk management, right? So I'd say that is where the real journey in terms of the world of trading for me began. So by the time I got my own clients, I'd also I'd read a whole heap of books. I joined a traders chat room that I think I mentioned to you, when we spoke last time. That's called CFD Traders Edge. So that was still is run by a trader by the name of Alan McGrath, who's now a pretty good friend of mine. And Alan became, I guess, somewhat of a mentor to me. So, I'm in the chat room. I'm obviously doing my work all day, but I was sponging off him and really watching him get in and out of stocks intraday. While I was at work, speaking to clients on the phone, I'm just watching the screens and watching what he was doing. So yeah, I mean, that's how I basically started to pick things up. And, in the beginning, I guess, my results with clients were pretty mixed. Some did okay, others not so well. And, eventually after watching the screens all day, and particularly, watching the order book, I call it the order book, they call it level 2 in America, I really recognised that, perhaps there was an edge to be exploited in trading the order book on a short-term basis. That's kind of when I had a bit of an aha moment. And, I had a handful of clients that were, open to more short-term trading. And that's where I began to have a little bit more success. So, I did that for a couple of months before I realised that, the economics of short-term trading with a full-service broker, it just doesn't work. To ensure that I wasn't churning commission out of my clients, I had to drop them to a rate that was so low that, I wasn't really making any money. And the boss wasn't happy, of course, but the upside was that I was learning a lot, and I was obviously getting paid to learn. So it was pretty good to pick things up like that. So
cool. Okay, Bryce. Well, let's now drill down into more about the ins and outs of your trading. So how would you describe the approach you now trade? I mean, you mentioned the order book, and of course got a bunch of questions around that to come. But just if you could give us an overview of your approach, and maybe also if you could share with us how this has changed over the past few years, because I believe you were more of a scalper to start out with when you first went from being a broker to trading full time.
Yeah, correct. So, I guess a general classification, I'd probably say that I'm a discretionary intraday stock trader. So I try and go home as close to flat as possible every day. The obvious reason is to minimise overnight risk, but I think for me, more importantly, is that I can be 100% focused on news plays the next morning, and that way I'm on the offensive. And I found that initially when I was trying to find my own style, any time that I came in and I had a bunch of stocks to deal with, I'd always have to worry about putting out fires in the morning. Rather than being on the offensive. So, I try to go home as flat as possible. Company news, I'd say, is my bread and butter. So that's something that I picked up again from Alan McGrath in his chat room. And, I think I mentioned to you last time that I'm also a big fan of S&B Capital. So Mike Bellafiore's book called The Playbook, that really helped me structure my approach, to trading. I mean, the importance of process, of repetition, and also, the big takeaway for me is this concept of stocks in play. So that was really powerful. I think that came out maybe 6 months before I finished up broking, and it was kind of that book that I thought, hey, the stories of all these young guys that were having a good go at it, and I thought that, that's something that I'd really like to do. So, the stocks in play, it's probably the backbone of what I do every morning. So every morning I'm building a list where I'm basically looking to trade stocks that have a catalyst. So my goal is to be in the right stocks every day. That is the stocks that move the most. And I find that, your risk reward is far better when there's a catalyst to drive the move in the stock, if that makes sense.
Absolutely, yeah. And I mean, I'm quite keen to read that book also by Mike Bellafiore. And Mike has been on the podcast in the past for those listening. If you want to check that out, that's episode 22. Really awesome to have him on. So, Bryce, what markets are you most focused on? Is it just Australian equities, or do you, go outside of those as well?
Yeah, no, 100% Australian equities. I mean, for a while there, I considered, potentially moving across to the US purely for liquidity reasons. I see these guys that are trading these NASDAQ stocks and, making these huge, intraday profits. But I think, I came to the realization that it was, more my self-limiting beliefs than it was, that the Australian market didn't offer the opportunity, So, and that's, really where I had to tweak, try and tweak my strategy and, and focus more on these stocks in play. So, and when I say stocks in play, I mean, I'm obviously looking for a catalyst, and in particular company news. So, when a company wins a new contract or they announce an earnings upgrade, that's the sort of thing that, I'm interested in. And also I think, with these types of trades, if you time your entry correctly, oftentimes you'll be in profit, right from the get-go, and they kind of move quite quickly. And so, you can potentially run quite a bigger size position and have a really tight stop loss, so that your risk is small, but your upside's quite big if you time your entry right and the stock goes in your favor. So I think, that's something that works quite well. And obviously when there's a catalyst, around company news and that sort of thing, you get bigger volume and more liquidity as well. Trading company news is the main focus. But I mean, there's heaps of different types of catalysts that you can look for. I mean, I mentioned to you that I also trade around broker upgrades and downgrades. That tends to be a good catalyst. Particularly now, I mean, in Australia, it's AGM season right now. So you get quite a number of companies that will bury a trading update within the chairman's AGM address. So when the chairman's addressing the meeting, that address has to be released to the market prior to it actually happening in real time. And so the stock might not move much in a day, but you might find that the broker sees something in the trading update that they like, and they might upgrade the stock overnight. So let's say they upgrade, from neutral to overweight, and that tends to generate a lot of institutional flow the following day. I mean, it depends on the broker. If it's a retail broker like Bell Potter or CBA, they don't have institutional clients that are following the flow. But, these bulge bracket banks with Citibank, Credit Suisse, JP Morgan, Goldman Sachs, they tend to have a lot of institutions that act on their research. And so they're the ones that can often generate good flow. And, so the broker calls can be great catalysts.
Okay, cool. Yeah, that's really interesting, actually. And I'm keen to ask a few more questions around that as well. But just right now, before we move on, I want to zoom in on the order book, because I know this plays a really important role in your trading. And, like you mentioned earlier, the order book is just the same as the tape or level 2 for, those listening, outside of Australia.
Yep.
Why is the order book such an important part of your trading?
Well, I mean, for me, I started off scalping the order book and then sort of moved more towards also trading charts as I increased the size and the hold time of my positions. But I mean, my original theory was that, hey, if you're looking at a chart, it's kind of like driving, looking in the revision mirror. It's past tense. What needs to happen for a trade to take place to then print on the tape is that two orders must meet. So in terms of predicting the short-term move in a stock, the order book is at the very forefront of where the trade's happening. And so that to me was a really big, kind of aha moment. And it's sort of gone forward from there. So, I mean, in terms of my decision-making process, it is heavily weighted toward the order book. And, also I think, that definitely comes down to market microstructure. So, there's a really big difference between the Australian market and the US market in terms of microstructure. The order book in Australia is, I'd say it's probably a whole lot more reliable. So, for example, looking at the order book, I mean, I'll use the order book to manage risk. So if I, go to buy a stock, oftentimes I'll spot my exit in the book below, right? So if I'm going to buy a stock, I'll see a big line of bidders behind me that, if things don't work, generally if I put a trade on, it doesn't go in my favor straight away, then there's a good chance that it's probably not a winner, right? And so having those big bidders behind me that I can turn around and hit out on and stop my trade out, I found there was a certain element of risk management in it. So the volume or the size of the bids below is going to help me determine my position size in terms of risk management. So, let's say I want to take a $10,000 position in a stock. If it's quite a liquid stock and there's only, say, 2,000 units within close proximity, bid below, then I'm not going to take 10,000 units because I don't know that I can get out, within close proximity, my whole 10,000 units, if that makes sense. So I think that's a really big difference. I mean, I think you'll find if you speak to a lot of US traders, they'll say that, because of market makers and whatever else, all the spoofing and phantom liquidity that goes on in the States, I think you'll probably find that those bids that, I'm relying on to hit out on, there's a good chance they're not going to be there in the States when you want to exit. And that's because of the market microstructure. Does that make sense?
Yeah, no, it does. So, I mean, this is something we've spoke a little bit about in the past, and I don't know, you may have kind of touched on it there. You say that the Australian order book is lit, and there's a big difference between that and how that compares to the order book or the level 2 in the States. So could you just explain what you mean by the Australian order book is lit and how that differs?
Sure. Well, I mean, obviously there's the lit market and, dark pools, right? So, the US market, obviously they're lit markets as well, but it's a little bit different. So let's say, for example, in Australia, you can't really mask the size of your order like you can in the States. And, I mean, correct me if I'm wrong. I mean, I don't do a lot of US trading at all. So, perhaps I'm wrong, but it's my understanding that in the US, you'll see, a heap of 100-lot bids in the book. And so that could be someone that's trying to buy 100 lots, 100 units genuinely, or it could also be someone that's trying to buy 10,000 units and they're actually masking their order, right? So they're only revealing the first 100 units of their order. And so that's what I mean by masking in a true lit book. In Australia, you can't mask the size of your order. So what you're looking at, I mean, what you see is what you get for the most part. We've got icebergs and different special order types, undisclosed bids, undisclosed offers. There are a number of different institutional orders that kind of allow you to hide your liquidity. But for the most part, you'll find that, if you see a really big sell wall with say 40,000 units offered and you lift the lot, you're going to make the stock run, so you can tell how much it takes to break a stock. In terms of the order book and when a stock cracks, you know exactly what it's going to take to make the stock crack. So I think that's a really big advantage. And I think, without that, I think, I'd probably be more reliant on the tape and also on charts. But, because of the microstructure, I think you can put a little bit more weight to the order book when you're trading. And, outside of the order book, in terms of microstructure, it's quite different. So it's probably a little bit interesting to go over this, right? So in Australia, there's only 2 exchanges. The ASX is the major exchange, so they basically used to have a monopoly. They still do, I think it's probably around 90% of the total turnover happens on the ASX, right? And, there's a second exchange called the Chi-X. That only launched probably 3 or, maybe 4 years ago now, and they do the remaining 10%, right? So when I'm looking at the order book, I don't even really look at the Chi-X because, the Chi-X is where you get a lot more algo activity, a lot more HFT, and so I'm only really looking at the order book or the level 2 on one exchange, the ASX, and they do 90% of the turnover. So it's very, very different. And, you compare that to the States. How many exchanges has the States got? 16 or 17 different exchanges and God knows how many dark pools. So there's going to be a lot less HFT, a lot less market making in Australia because I guess, there's a lot less opportunity for this kind of latency arbitrage that happens between exchanges. It's a big difference.
Sure. No, well, thank you very much for, going into that, Bryce. That's really fascinating.
Ever watch a stock rip and think, I could have nailed that if I had real capital. The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Now, one of the types of trades that you focus on, you describe as trading a wall. And this might be a little bit difficult to describe without, visualizations, but could you give us just an overview of what this type of trade looks like and what causes these walls to occur?
Yeah, sure. As I say, without having an order book in front, it makes it a little bit difficult. But what you'll find in the order book is, there might be orders that gather around a particular price point. So if you have a large line of stock offered at a particular level, and that stock might be, that line of sellers might be, say, 10 times the amount of stock that's offered on any line or price difference right next door. And so when a big line like this wipes in the market, that's a sign to the market of conviction. So I often trade around walls, and oftentimes you'll find walls, at particular points of resistance and support. And so, say for example, if a stock has a resistance of $6, oftentimes you'll find a whole wall of sellers at $6. And so what oftentimes you can play a breakout and predict that wall breaking. If you see a lot of activity coming up to the wall and you see bids start to build behind the wall, and then someone starts to chip away at that wall, then you would buy that wall, and the huge volume that's just been done in lifting that offer creates momentum in the stock, and then things run hopefully in your favor. So trading around walls in the order book, it's kind of something that it's hard to explain, but if you're watching the order book enough, eventually you kind of pick it up.
Yeah, and I think you created a video which is available on YouTube, which kind of explains that a little bit more with obviously visualizations. So what I'll do is I'll link to that in the show notes in case anyone wants to check that out and find out a little bit more about it. All right, so besides the order book, I know there are other factors you also can consider, some you mentioned, such as news, commodity prices, broker gradings, etc., which I'd all like to ask you about in just a minute. But technical analysis, does this play a role in your trading? And if yes, how so?
Okay, well, originally it didn't. I was predominantly a really short-term order book scalper. But I guess I ran into some problems in terms of scaling up my, my positions as my account grew, and I found that inevitably, I couldn't just scalp any particular order book setup, and particularly because I'm relying on the order book for liquidity. I'd get to a point where, I'm going to have to take a bigger position than, the bids behind are going to afford me in terms of risk management. And so that's when trend trading, I changed my style, I guess, to trading with momentum. And, that's where you're able, because the wind's at your back. Let's say, for example, you're trading a strong stock, buy a strong stock at highs when the market's trending higher. You find that the wind's at your back, and even if things do reverse, there's a lot more liquidity than the order book will actually reveal. And so, it's really just been a case of scaling up my trading and trying to hold positions a little bit longer rather than being a scalper.
Okay, sure. So let's speak about the additional factors that we've kind of hit on already, but let's go into a little more depth. So, things such as news, underlying commodity prices, broker up and downgrades. What do you like to see happening in these areas? Maybe if you could give us an example of a recent scenario where this has happened.
Yeah, sure. I mean, when this is all in relation to, building a stocks in playlist. So, in terms of catalysts, I mean, I've explained company news, broker upgrades and downgrades, that there's any type of catalyst, then I'll look for in the morning. I mean, I get up, read two different papers. I've sort of got a set routine that I go to look for to build my list of stocks in play in the morning. Obviously, in Australia, we're heavily weighted toward resource stocks, and oftentimes you can get some really nice lead-ins from overnight moves in commodities. So, moves in commodities can make for some pretty good catalysts. Let's say, for example, nickel might be down 6% on the LME overnight. And so, I'll come in and look to short nickel stocks, moves in copper or gold or the oil price, anything that is going to provide a catalyst. And there's also, there's a bunch of US listed ETFs that I also monitor for the same reason. So, oftentimes you'll find, just because gold's up, it doesn't necessarily mean that the gold stocks have been up. So for that reason, in gold in particular, I might take a look at the Huey index or the GDX, the GDXJ. There's a bunch of different indexes. If crude is down a lot, then, I want to have a look at, which, US energy ETFs have moved. So I think the tickers for the energy ETFs are XOP and the other one's XLE. I think XOP is the one that I look at the most. So there's plenty of places that you can look for a really good catalyst, but at the end of the day, that's only really the first step in the process. So just because a stock is has a catalyst and it's on my morning list, it doesn't necessarily mean that it's a trade. It's still got to qualify as a trade. So I'm still looking for a good setup in the order book. I'm trying to time my entry into the trade. And, that's all based on price action, watching the tape, and obviously the order book.
Okay, sure. Well, I'd like to ask you that, but just quickly, on average, how many stocks might be on your stocks and playlist each day, just on average?
Probably 20.
Okay, so how do you go about tracking this list of, let's say 20 stocks throughout the day? Because I'm sure it's very tricky to track the order book of this many stocks. I mean, how do you approach that? Do you utilize any type of technology? Do you have your monitors set up in a certain way? It would be great to hear more about this.
Sure. You're right. But in terms of, so I basically, start with stocks in play. I mean, the open is a little bit different here in Australia. I'm not 100% sure how it works in Australia, but in the US, sorry. But, we have an auction at the beginning of the day, and then our market opens in 5 phases. And so it goes group 1, which is, all the tickers starting with A and B. Group 2, the tickers from C, D, E, and F. Group 3, so there's this 5-stage or 5-phase open, and there's 2.5 minutes in between each phase. So, I'll firstly look at all the A's and B's, and then I'll, trade phase 1, and then I'll trade phase 2 and trade phase 3. Sometimes if, let's say in phase 1, I make 2 trades or 1 trade, it's really good if that's a winning trade, because then, I don't really have to worry about, trying to put out a fire. I can move straight to phase 2. Oftentimes if I have a couple of losing trades in the beginning of the 5-phase open, it means that, I'm kind of tied up trying to stop out trades, and I can't trade what's happening in the later phases. So, it's kind of a bit of a juggling act for the first 10 minutes. But it's generally the first sort of 10 or 15 minutes that I'm trading those stocks in play. I then move to a different kind of process to trade momentum trades from, sort of 10 or 15 minutes after the open. So, in particular, if the market's really bulled up, let's say we get a really strong lead in from Wall Street, the Dow's up 1.5%. The SPY futures here are indicating, we might be up 1.5%. And so in the morning, after I've traded that stocks in playlist, I'll then go and look to get, market exposure. And so this is what I referred to before. I'm going to be trading or buying strong stocks, trading at their highs. For the most part lately, that's been tech stocks. But yeah, I'll go and do a bunch of scans for, stocks trading within 2% or 3% of the 52-week highs. That might produce a list of, 100 stocks. And then I'll use a scanner intraday to filter those stocks and only show me the stocks that are trading at their highs. And then I'm just going to go and buy the new high. So that's something that works pretty well in terms of momentum when you've got the market at your back. And that doesn't necessarily have to be news. So that's just, trading with the market. And so if the market's going up, I'm looking to buy stocks. If the market rolls over, I'm cutting my long positions, and I might start to look for shorts. And the shorts is just the same in reverse. I'm looking to short weak stocks trading at their lows. It's more of a momentum game.
Okay, and you mentioned in there that you were using some scanning software during the middle of the day to find stocks trading at their highs. Do you mind sharing what that is?
Yeah, it's a platform called Spark. It's not available in the US, but yeah, it's a huge advantage. I've got Spark running on 4 different screens. In terms of using technology, at the end of the day, as a retail trader, you don't really have an information edge over institutions. Your biggest edge is, your pretty small size and your speed of execution and your ability to get in and out of the market quite quickly. And I think, if you can use technology to keep more eyes on the market, then, you could potentially trade more of your best setups. And so Spark, there's a whole, different... there's a whole bunch of really cool smart lists and watch lists and ways that you can filter the market to basically push to you, your best setups. And so that's kind of what, I've used Spark for. It's, you've only got 2 eyes and 4 screens. There's a limited amount of things that you can see, in terms of what's going on in the market every day. So if you can use technology to bring more trades or more of your best setups to your fingertips, then, hopefully you'll be more profitable.
Absolutely. Now, as a day trader, it's can be quite easy to get chopped up with just your commissions alone, jumping in and out of the market a lot. So how do you make a conscious attempt to be mindful of commissions as a day trader? Does that mean that you're only trading your A+, your best setups, or tell us how do you work around that?
Yeah, sure. That's a really good question. It's something that I struggled with quite a lot in the beginning. The first answer is obviously just to trade stocks in play. When you get much bigger moves in stocks in comparison to your commission charge, then naturally, your commissions are going to eat into your profits a little bit less. So for that reason, I focus in the stocks in play. I generally steer clear of the large cap stocks, things like banks, Telstra, your Woolies and your Wesfarmers. I don't tend to trade those large stocks because they don't really move much during the day. So you just end up, chewing up commission, and I kind of don't really have an edge there anyway. Unless of course it's on news, then, it's certainly in play and I'll have a look at it. But for the most part, trading mid-cap stocks and trading where there's a catalyst. But I think something that took me maybe a year to really work out is that, you don't need to be trading in the middle of the day. I tend to be way more active in the first hour, and then, also in the last hour of trade. That's when things happen. If you're trading in the middle of the day, oftentimes, particularly if the market isn't trending, you just tend to get chopped up, and you just end up churning commission. So, in the middle of the day, there's got to be a really good reason for taking a trade. most of the money for me is made in the opening hour. Just be more selective in the middle of the day, I guess. So that's the major thing that I've sort of come across in the last year. But I think the easiest way to save on commissions is obviously pay less to your broker, and I think commissions here in Australia are really high. I mean, we don't have the turnover, we don't have the economy of scale, or the same sort of competition that you get in the US. So it is actually quite expensive to trade in Australia. The ASX, as I said before, has a virtual monopoly. The exchange fees, the settlement fees, these are basically input costs to your commission rate as a trader. And so by global standards, our commissions are really, really high. We, in Australia, we get charged on a percentage of trade value. So in the US, people are probably familiar with a cents per share structure, where it's very, very cheap to trade, stocks that are trading at $1, and it doesn't work like that in Australia. So, if you're going to trade, $100,000 worth of a small specky, it's going to cost you the same as $100,000 worth of, a large cap stock. So it's a little bit different, and your commission, is quoted in basis points. It's if you've got a really small account and you're doing small turnover, you probably shouldn't be paying any more than say 8 basis points. So that's $8 for every $10,000 that you're trading. It's also pretty important to ensure that your broker doesn't charge you a minimum ticket charge. Oftentimes you'll see brokers quote 8 basis points with a $10 minimum ticket charge, which is no good. If you've got a really small account and you're only trading $5,000 lots and you hit with a minimum ticket charge instead of the basis point rate, then that's going to eat into your profits. You want no minimums. Once you start doing a lot more volume, you can sort of negotiate a pretty good rate. I mean, I'm currently on a rate of 2.5 basis points, so that's $2.50 for every $10,000 that I'm turning over, which is really, really competitive. I think, traders in Australia would be surprised that you can actually get a rate that low, 2.5 basis points. So, I won't shamelessly plug my broker, but I mean, if anyone wants, to ask questions about brokers, I'd be happy to help. I mean, I can answer questions on your site, or they can contact me via email. I think getting the right broker is pretty important.
Sure. Okay. And just one thing before we wrap this up, you mentioned in your answer there that during the middle of the day you're not overly active. Are you still at your computer, watching the market intensively throughout the day, or do you find that you leave your computer and go and do something else?
No way. I'm always at my screens. I mean, I'll go down to get lunch for all of about 5 minutes, and then I'm back up eating lunch at my desk. So, yeah, it's I mean, it's if you have a really bad day and you make some mistakes and break some rules and you've put a dent in your account, yeah, sure. I mean, cool off, go take a walk. But for the most part, if you're keen, you got to be at the screens. If otherwise, you're just going to miss opportunity. But each to their own. I guess if the market's not doing that much, then sure, take a bit of a long lunch.
Absolutely. Okay. All right, Bryce. Well, this has been awesome. I mean, I'm really glad that you said yes to an interview because, you've shared a lot of insight. I've found it really interesting myself, and I've no doubt that people listening will also. So, yeah, thank you very much for doing this.
Mate, thanks for having me on. And I have to say thank you for keeping us punters up to date with an awesome resource. I mean, I'm still making my way through the past episodes, and it really is a goldmine of content that you're creating here for us. So keep it up, and I look forward to chatting again with you soon.
Awesome, no doubt. And just one last thing, where can listeners get in touch with you? I mean, you mentioned your email before. What is your well, I mean, do you want people to email you? Or,
yeah, that's fine. I mean, I don't have a blog or anything like that, so email's probably the only contact. So it's my name, Bryce Edwards. The number's 80@gmail.com.
Okay, sure. And you're not on Twitter?
I am, but I don't really tweet.
Not very active?
No.
Fair enough. Okay. And alternatively, guys, maybe also, as an alternative, just leave a comment on the website in case, some people have similar questions. Bryce can answer everything in one place, and I think that could be a cool resource just to get a little bit more info as well for everyone. So, if you have a question for Bryce, either email or in the comments on the website at chatwithtraders.com. All right, Bryce, take care, and let's talk again very soon.
Thanks, mate. Will do.
Hey, thanks so much for listening, team. I hope you really enjoyed this interview with Bryce. I'm sure we'll be hearing from him again at some point, so that's something to look forward to. If there are any questions you'd like to ask him, anything around day trading, the order book, catalysts for intraday moves, momentum, pretty much anything trading related, go to chatwithtraders.com/51 and drop a line in the comments area. Bryce is keen to answer your questions and help out, so please take advantage of this. And I also realized it's been a while since I mentioned the premium ebook that we have available here at Chat with Traders titled Why Most Traders Never Succeed. So if you haven't had a chance to read this yet, or you haven't even heard of it, I strongly encourage you to check it out. Inside, you'll find the responses from 18 traders who have previously featured on the podcast, explaining the key reasons why most traders lose money and eventually crash and burn. To find out more about this ebook, which I've received really great feedback on from those who have read it, go to chatwithtraders.com/read, READ, and you can purchase a copy for just $15, and you'll pretty much get an email right away with an instant link to download. So again, that's chatwithtraders.com/read, READ, and you can purchase it right there on the site. All right, guys, I think we've covered plenty of ground again this week. Until next time, take care, and we'll speak soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the measured by level.
This week, I guess you could say Ernie had somewhat, and I had the great...
Here's your host, Aaron Fifield.
What's going on, traders? I hope you're doing great, and welcome to the podcast. This week, we're at episode 52, and I had the great pleasure of speaking with Dr. Ernest Chan. While many traders in the quantitative arena will already be familiar with Ernie, I'll give just a quick 30-second intro, and then we'll get into the interview. So I guess you could say Ernie had somewhat of an unconventional introduction to trading. He started out on a research team at IBM, using machine learning and artificial intelligence techniques, teaching computers to understand human languages before joining a prop trading group. Today, Ernie has upwards of 15 years applying similar techniques to the domain of finance and trading, working with multiple prop firms and hedge funds across his career. And as of right now, Ernie is the managing member of QTS Capital Management. Just to top it off, Ernie has also written 2 books, Quantitative Trading and Algorithmic Trading, and he speaks at conferences regularly. Some of the topics we covered during this episode are diversification, capital allocation, generating strategy ideas, backtesting, and a whole lot more. And you can get a full recap on this episode at chatwithtraders.com/52. You can find everything there all in one place. All right, guys, let's do this. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is my guest from Toronto, Canada, Ernie Chan. Hey, Ernie, how's it going?
Oh, I'm fine. Thanks for talking to me, Aaron.
No trouble whatsoever. It's nice to be speaking with you. Thanks a million for doing this. I'm really keen to dig in and get some of your insight on how you've had such great success in markets. I've been looking forward to this. So let's begin by talking about how it all began for you. Firstly, you graduated with a PhD in physics. Where did you go from there?
Well, I went to IBM Research to do something quite different from physics in the field of really machine learning and artificial intelligence. So I spent about 3 years as a researcher there before I moved on to finance.
Okay, and what were some of the tasks that you were working on there with your AI and machine learning at IBM?
Well, the group is focused on teaching the computer to understand human language in all of its manifestations, such as machine translation, such as speech recognition, such as natural language understanding, meaning that understanding how to respond to a human inquiry. Like nowadays, if you speak to iPhone Siri, they will do whatever you tell them to do. That's the part of the research we did, and also how to retrieve relevant information in response to a human language query, like what Google is doing today. So, but bear in mind that was in 1994. At that time, Google did not exist, and Apple does not have iPhone yet. So we were, in the quite early stages of this kind of applications. But the interesting thing is that the group take a purely statistical approach. We do not have any people actually that really understand linguistics or anything. Everything is based on massive statistical models applied to data.
Okay, yeah, and I mean, I can imagine a lot has changed since that time. So share with us, how did you actually get into trading?
Well, after IBM, I decided to move to live in New York City. IBM, though it's a great organization, has a research headquarters really in the middle of nowhere, and I prefer a more urban lifestyle. So I moved to Manhattan, and pretty much the only kind of jobs in Manhattan at that time that are suitable for a person with my background would be in finance. So I joined the data mining AI group at Morgan Stanley, and it's an internal consulting group that consult for many different business units. However, one of the business that we consult for are the trading desk of Morgan Stanley, and so we have given some opportunity to develop trading models. To see if they could be useful to some of our firm's traders. So that's really my first introduction to trading. It's really from a research, supplying machine learning algorithms for trading research, for trading strategies research.
Okay, so up until that point, you hadn't really had any interest or desire to really become a trader. It was more just those were the jobs that were available at the time. Is that right?
That's right. My interest was in machine learning and artificial intelligence. It's not necessarily in whatever domain that it can be applied to. I'm more interested in the approach, the technique, rather than the subject matter. So whether the subject matter is human language or financial data, it doesn't make too much difference to me.
Okay, yeah, that's really interesting. That's actually something I was going to ask you about. So you've beat me to it. But is that still the case for you?
Well, I retain my interest in machine learning and artificial intelligence, but I am also, evidently after focusing on one domain, which is trading, for about how many years that would be? Maybe about more than 15, 17 years. Obviously, I'm now very interested in financial market per se. So yes, my interest has narrowed considerably to one domain, which is finance. But I'm still, of course, interested in the techniques of machine learning and AI, though not on its application to other fields other than finance.
Sure. Okay. So following your position at Morgan Stanley, I mean, what was the next step from there onwards?
Well, the group in Morgan Stanley sort of scattered a little bit after I joined, because the main sponsor of the group was hired away by Deutsche Bank to head up their global equities trading. He became a very senior executive. He was a very senior executive at Morgan Stanley. He was the head of the U.S. equity trading at Morgan. But at Deutsche Bank, he became the global head of equities trading. So, it's a step up for him. But without this big sponsor behind our group, we a little bit at a loss for finding clients. So some of our colleagues decided to leave the firm and go on to Credit Suisse and started our own proprietary trading group. So I was asked to join them, and I agreed. So we went off to a prop trading group in Credit Suisse to apply these techniques that we have been researching all along.
Okay, good one. Now, I usually ask this question, and I'm not sure if it's quite so relevant to your background, but I'm going to ask it anyway, and you can give me your thoughts. So, let's say in the period of your first 5 years being involved with financial markets, what were some of the greatest difficulties you encountered that really challenged you?
Well, as with many of the algorithmic trading models, the greatest difficulty is that your model can look very good on a backtest basis, but it is very hard to know if it is actually going to perform well in practice. And when I first applied these techniques to trading, obviously I don't have a lot of experience and intuition about the financial markets. And so I approach it in a rather theoretical, or you can say mechanical manner. And it turns out that actually almost every model that we produce didn't work in live trading. It worked perfectly in a backtest basis, but it's completely fail in the live trading. So that's certainly a big challenge for us.
Okay, yeah, that makes sense. So pretty much what you're saying is that even if you do have the the knowledge of machine learning and AI and those types of things, applying them to financial markets, it still is very beneficial to have an understanding of how the market operates. It's not just as black and white as that's a different data set that you're now working with.
Yes, because at that time at least the data set that is for financial markets are very sparse compared to other sort of machine learning data sets. Typically we would feed millions of articles into a machine learning system for it to teach it to understand human language, for example, literally millions. And whereas for financial data, especially if we are trading daily data, not high frequency trading, but daily data, there aren't enough data to really train the system properly. And so human intuition, I find, was necessary to really constrain the system so that it can result in sensible results, even with very limited data.
Right, okay. Yeah, that's really interesting. Now, Ernie, how would you describe your style of trading to anyone who is completely unfamiliar with your work? So share with us maybe the frequency that you're trading, what markets, and just a little bit of more insight to your quantitative approach.
Well, our focus is really in the intraday trading, but not high frequency trading. The reason for that particular time frame is that if it gives us a good enough Sharpe ratios, and and a good Sharpe ratio indicate a good statistical significance, so that we know that whatever result we are seeing is not pure luck. So there are enough trades to convince us that we are doing something correctly, not just random luck. But it is not high frequency trading, because to go into high frequency trading requires a much higher investment in the infrastructure that at our level of asset is not justified. So yeah, we focus on the intraday trading that holds for several hours at the on the average. And we focus initially on Forex because that's the most liquid market. And then later on we added the futures models and then also stocks models. So and now we actually dabble in options as well. So we are constantly looking for new models. So, and we do not restrict ourselves in terms of what markets we can research and trade on.
Okay, so trading such a wide range of markets, do you find that the strategies you develop for each market are vastly different, or is it sometimes the case that a strategy for stocks may also work effectively on futures?
The strategies are vastly different. I know that there are futures traders, for example, who believe that you can trade orange juice future the same way as you trade the gold futures, and the same way that you can trade oil futures. If they can find such a model, all the power to them, I say, but we couldn't. So we have a separate model for every future. And you might say, well, that sounds like overfitting to the particular future. Well, the results speak for itself. The model that we focus on each market has a very decent Sharpe ratio and a decent return. So, and we have been running it for a while live, and it will not work on any other market. It just work on that single market. So practically for every single instrument, we have a separate model for it.
Okay, and how do you deal with that when you come to markets such as just the equities and stocks markets, as well as options? Or do you have do your strategies operate on just a basket of stocks, or are they still individual strategies for individual stocks?
Yes, stocks are different because we typically run stocks in a market neutral strategy. So essentially a stock selection model. So we have one model to select what stock to buy and sell every day. And so indeed the same selection model is applicable to all the stocks.
Okay, sure. So running multiple strategies at any given time, in your opinion, what are the benefits of doing this? And could you give us an idea on how many maybe different strategies you're running?
We run over 7 or 8 strategies. Now, some of them have very little allocation. Some of them have a large allocation, so they're not equally capitalized. So some of them are in the experimental stage, so they have a trivial allocation. So the benefit, of course, is diversification. As a portfolio are subject to many risks. There are risks due to, for example, if you're long only portfolio, of course, it will be subject to market risk. If you are market neutral, but somehow overweighted on, let's say, one sector of stocks and underweighted in the other sector of stock, so you will still have some factor risk. Even if there are some other risks that are not so apparent. So, for example, you have if you're running options, portfolio, you might be have a negative vega. So you might be sensitive to volatility. So if volatility goes up, your portfolio will go down. Or you might be sensitive to interest rate. If interest rate goes up, your portfolio will go down. So every strategy has its sort of sensitivity to a particular risk: volatility, interest rate, market risk, factor risk, whatnot. And the goal of a well-balanced portfolio is that you want to neutralize any of this risk. So, and you can't do that with just one strategy. Each strategy is going to have a soft spot, and it's going to be vulnerable to particular risk. But if you're running multiple strategies, hopefully their sensitivity neutralize each other. So, a simple example is a long-short portfolio neutralize market risk. If you are, your long portfolio benefit from increase in stock index, but the short portfolio will be hurt. But the sum of those two, the net of those two sides of the portfolio, will practically have no risk. So that's what they call it market neutral. It will not be affected by the movement of the market index. And the same can be applied to any of these risk factors, whether it's volatility, interest rate, and so forth. And that's the goal of our portfolio, is to be neutral to any or most of these risk factors. Now, of course, we are not that smart. We cannot. We really haven't figured out exactly, under some weird circumstance, there's some risk that we have not neutralized. But some of the obvious risk we have eliminated because of diversification.
Okay, yeah, that's excellent. Now, let's imagine that an entry-level quant has created a trading system. They have a single strategy and are satisfied with the results from testing it. Is it wise for them to trade this without having other strategies to diversify?
Yes, I mean you can't just sit there and wait for 10 different strategies to all be ready to go before we start trading. So when we started our fund, we only traded one strategy, and obviously it was a very risky portfolio, and so we had a big drawdown. So that was unfortunate. But if we were to do it again, we would have lowered the leverage a lot. So until we get diversified. So yes, I mean if you have just one strategy, you could also you should start trading it, but one should not over lever one single strategy.
Great. Yeah, I think that's really well said, Ernie. Now, I understand your strategies are designed to catch momentum, and then some are also designed to capitalize on mean reverting. Do you have to decide which strategy types are best for the current market conditions by turning them on and off, or is this something that's programmed into your algorithms?
No, we have not found a way to be able to predict, in the next month, whether a momentum strategy will work or a reverting strategy will work. It is very easy, of course, to do it in hindsight. We say, oh, geez, this last month we should have just run the momentum strategy. We should not have run the mean reverting strategy. But how do you tell next month whether you should do so? We have not found a model that can do that. Other people claim that they have this kind of regime shifting model, and again, all the power to them, but we couldn't. So what we do is that we, as I said, we run multiple models all at the same time, so that now some model will lose and some will gain. And hopefully the model that lose will lose less than the ones who gain, that gain. That's a very delicate balance, of course. We don't always do it right, so we do have some down months. We are not able to completely eliminate the risk so that we have up months, every month. That would be wonderful, but, we didn't get to that perfection yet. But so far, it has been the case that indeed most months are positive, and the down months are down much less. Well, not much less, but less than the up months are up. So we did not suffer big drawdown in a well-balanced fund portfolio. And so, it seems that the approach at least worked to a decent extent.
Right. So with that being said, are there any discretionary elements to your trading style?
Well, there is some discretion element in terms of the allocation to the particular strategy, and the reason for that is that we constantly, some of our strategies are lucky enough to have worked from day one, and although they had been drawn down, never stopped working. So, we've been trading it for more than 4 years, and, they form the backbone of our fund. But there are other strategies that we started and it might work for a year and then it become quite weak and start to lose money month after month. And so we need to reduce their leverage. Well, in that sense, it's somewhat systematically. We do reduce them based on their loss. But there are other strategy that we just created is a new strategy. Now, with a new strategy, you never know how much to allocate to it. I would say that it is imprudent to immediately allocate, just based on backtest. Oh, this strategy has a Sharpe ratio of 2. Let's allocate it based on the backtest Sharpe ratio. I think that would be imprudent because no matter how well your backtest is, there is always the possibility of A, overfitting, data snooping bias, and B, regime change. So the live, and also thirdly, you don't know exactly what the market impact is until you actually trade it in substantial size. So therefore, when we start a new strategy, we are always starting it at a very low leverage and gradually increase it to the proper allocation. And that process is discretionary because I don't see that there is that's no way to sort of systematically increase a new strategy because whatever systematic way that you can count on is based on backtest, and the backtest already says that this is great. So, but the point is that we don't believe the backtest. Since we don't completely believe the backtest, there's necessary discretion involved in how fast you increase the leverage. So that part, I would say that capital allocation in the face of dynamically changing strategy pool, some of them are dying, some of them are getting born. That process has a discretionary element to it.
Okay, that's really great. Now, I'm really keen to ask you more about backtesting actually in a little bit, but right now I'd like to ask you a couple questions about some of the less obvious differences between discretionary and quantitative trading. So let me ask you this. How does profit distribution differ between discretionary and quantitative strategies? And the reason I ask that is because some discretionary traders will say their profits are quite lumpy. So they'll say that 90% of their profits come from 10% of their trades. Do you find this is also the case with quant trading strategies, or is the equity curve somewhat smoother?
Well, I think that the difference is not between discretionary trading or algorithmic trading. The difference is between mean reverting and momentum strategies. Typically, the characteristic of a mean reverting strategy is that the profit of every trade is very similar. And almost every trade will be profitable, except there are a few trades, very rare trades, that will lose maybe 10 times the typical profit of a trade. That's the characteristic of a mean reverting strategy. Whether you're running a mean reverting strategy by discretion or by algorithm, it would have the same characteristic. The opposite occurs for momentum strategy. Momentum strategy is such that a lot of trades will not be successful. In fact, they will lose a little bit of money. But once in a while, there will be a rare trade that will make 10 times as, or maybe more, profit than the typical losses of a momentum trade. So I would say that the sort of the profile of profits that you describe are really, I would say, differentiated by the whether it's mean reversion or momentum. Now, discretion or not, I think that the problem with discretion. Now, there's pros and cons to discretion versus algorithmic. The good thing about discretion discretionary trading is that you can take into the context of, macroeconomics. There are a lot of variables that you can take into context, like did a major earthquake just happen? Did some major government decision just being made in some corner of the world? Your model could not possibly take into account all those rare events, but a human can. So, a human can say, well, today obviously there's maybe a major default that is looming over Greece, and we don't want to trade the euro bonds or something like that. Then that would be perfectly sensible, a sensible discretionary decision. But your model would never be able to make that sort of decision. So that's the good thing about discretion trading, that you can take into the context and particularly rare events. But the problem with discretionary trading is that a human brain can focus on only very few things at a time, and research has shown that multitasking doesn't work. If you do multitasking, all you get is the degraded performance in every task that we do. So as a discretionary trader, you're unlikely to be able to manage more than a small handful of strategies. And as a result, the equity curve will not be terribly smooth. And unless you're just running a very high frequency mean inverting strategy. But because of the lack of diversification, for a discretionary trader, it is very unlikely that your Sharpe ratio will not be as high as a well-diversified algorithmic trading portfolio. And indeed, it will look kind of rugged, the equity curve. And that might be why one might see a different shape of the equity curve, being not as smooth as algorithmic trading. It's simply a consequence of the lack of diversification in the discretionary case. I challenge a discretionary trader to run, 7 day trading strategies simultaneously. I don't know how they would be able to do that.
Yeah, that's very well said, Ernie. Thank you for explaining that. You mentioned in there that while you can't take all news and macro events into consideration, do you take some of these news events and sentiment into consideration when developing your strategies, or is it purely always just based off price?
Well, at this point, we in developing the strategy, we have not been able to take into account the news. But certainly nowadays there are more and more vendors of news sentiment data. We may be able to incorporate that going forward. But even though the back test does not incorporate news sentiment, there are some exceptional events that we would take into account when we are trading the model live. So there are some rare occasions that we would indeed override a model in the sense that we will shut down the model because we don't believe that the model has incorporated those events that is coming up. And so from a risk management point of view, we will not trade because of those events, such as natural disaster or major economic event. So that's another place where discretion would come in, is that because our model does not have news data as input, we feel that it is prudent to sometimes override a model and not trade because of some exceptional news.
Okay, yeah, that makes sense.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access your professionals
of ideas out there in the public.
Generating
meet you where you are and take you that next step further. The markets have evolved.
Ideas for viable trading strategies.
Well, I'm a sort of a vacuum cleaner of ideas out there in the public. And, I have follow a number of trader accounts. And these are all accounts which regularly, on a daily basis, publish the headlines of new articles on finance and trading. So I would always make note of those that look interesting, and I will read them when I have time. And and I get ideas from some of them. I also, of course, keep always look for books on trading, from fairly elementary books to books that stands with equations or full spectrum of them. I regularly consume them, and then also. In the course of live trading, oftentimes you will observe phenomenon from your P&L. And that's one thing that really distinguish between a researcher that just sit in the office and research and look at papers and look at data, versus a trader who are actually watching the market in real time, because the information, sometimes your brain would capture information when real money is at stake that you would never be able to capture if it's just backtesting. So I often would get inspirations from some particularly unusual P&L pattern during the day that can be utilized for developing new trading models. It's from a variety of sources that these trading ideas come from.
Yeah, that's a really great point. I'm glad you highlighted that. How do you feel about academic research on market studies and that type of thing? I mean, I think you kind of mentioned it there, but I mean, one of the things I've kind of heard about academic research is one of the precautions that you should take is that it's not necessarily realistic to replicate those results had it been, taken in a live market. I mean, are there any precautions that traders should be aware of if reading academic research?
Yes. Obviously, one should not just assume that these research are going to be profitable. And there are many reasons they may not turn out to be profitable. Some of them are because they have been overfitted to past data. Others are because they are have not taken into account transaction cost. And yet others are because the data they use are just not good enough. So, yes, most research, after you read it and you try to replicate it, it might not work after you have fixed some of the deficiencies. However, at the same time, once in a while you will come across some ideas that work. And even after backtesting, and it still stand up to the scrutiny, and and you trade it live, and it continue to work. And we have been trading one such a strategy, so that's proof that occasionally academic research does work. Now, one important point that I have made in my books is that even though a strategy that come from the academic research might work, it usually does not work exactly as described in the paper. So, no matter what, source of ideas we generate our trading strategy from, it does not mean that we are just, like slavishly copy what we have read. It always means that we have to make major modification. So anything we read in the public domain is to be treated as an inspiration only. It is not to be treated as a recipe. And I've made it very clear in my book also that I have described many strategies. And there are occasionally reader would come back, email me and say, hey, this strategy, after a couple of years doesn't work anymore. What's going on? I say, well, first of all, I'm trading that strategy live and it continues to work. Why is it that it worked for me but not for you? The reason is that I make modifications to the strategy that is slightly different from what I wrote in the book. So, and I encourage any reader to do the same. And I, in fact, urge them, make sure that they don't copy the strategies that anybody, not me, not anybody, not even a academic researcher's strategy in its entirety. Because obviously, very few people will be foolish enough to just disclose 100% of their trade secrets in domain. Not even an academic researcher. I can tell you that I've corresponded with many academic researchers, and if they are not only just doing pure academic research, but they may have an interest in a hedge fund, or maybe they are trading for their own account, there are some details that they have withheld from the model, and so did I. So it is very critical not to just slavishly follow a strategy that as written on the net or on the book or in the paper, but always make sure that you have modified it to your own taste and scrutinize it in using your own experience and your own criteria before you trade it.
Okay, so you mentioned in there that you have made modifications to your strategies over time. What's an example of like making a modification? Like, when do you decide it's a good time to make a modification? And I mean, is there a difference between just making a modification and dropping that strategy because it no longer works? Like, how do you know when to make a modification and when to stop trading the strategy?
Well, there are occasions where it is quite obvious what is causing the strategy to lose money. For example, you might be running a Bollinger Band strategy for mean reversion, and you might find that the strategy lose money when the volatility suddenly increase, so that what the previous width of the Bollinger Band is too narrow to be appropriate for the current high volatility regime. Well, one change you can make is to make your Bollinger Band perhaps the look back shorter, so that it's more responsive to the volatility. Or another way might be to impose a minimum volatility level for your Bollinger Band instead of just slavishly follow what's the past. You say, if the past has very low volatility, you would not follow it. You would still be, setting it at least at this width. That would be an example of how you would modify your strategy to deal with a particular problem. And of course, after you had this bright idea how to improve that strategy, add some feature or make some modification, you can also we must also backtest this new modification, right? It's not just saying that, I believe that this fix is going to do it. Well, of course, we have to go back and backtest it to see if that modification does improve things. Now, oftentimes what it happens is that it doesn't necessarily improve the return, but it might decrease the risk. And that might be an acceptable improvement. Just lowering the risk is oftentimes a great thing. You don't have to really improve the return.
Sure. Okay. Yeah, that's a really great point. And while we're on the subject of backtesting, I mean, let's just dive into it. So, what are some of the major pitfalls traders can experience when backtesting?
Well, one of the major pitfalls is data snooping bias, as we ourselves have experienced in the early days many times. The model is just simply too complicated, and so it just fit the historical data very well, but it has no predictive power. That's usually the main problem with backtesting. And the cure for that is typically to make sure that the model is simple enough and it actually sensible, not just produce good result, but sometimes you have to make sure that it's sensible. It is capturing certain market phenomenon that is perhaps well discussed elsewhere, so that it sort of increase the confidence that the model is picking up the signal, not the noise.
Yeah, and I mean, I guess that kind of comes back to what we hit on a little bit earlier about how it's important to have an understanding of how the market operates, as well as the programming knowledge. So let me ask you, to what extent can a backtest tell you the likelihood of a strategy producing similar results in the future? Like, how much do you rely on a backtest?
Well, we really regard a backtest as some sort of a rejection of a null hypothesis in statistical testing. In other words, we want the backtest to at least not produce negative results, because if it produces negative result, we pretty much reject the strategy. We don't have to spend further time and money on it. But if the strategy has produce a decent Sharpe ratio, and Sharpe ratio itself is pretty much a significance test. The higher the Sharpe ratio, the more statistical significance the strategy is. So if a strategy has a high positive Sharpe ratio, it really means that we are much more confident in that backtest. Doesn't mean that it will also work in live testing, but a high Sharpe ratio backtest enables us to find out if it is overfitted very quickly in live trading. Because if you have a strategy that, for example, has an astronomical Sharpe ratio, 10, let's say, practically, every day, if not, every week, if not every day, it would be profitable. If you have a Sharpe ratio 10, that's pretty much guaranteed that every week you'll be profitable, and practically every day you'll be profitable. So if you run the strategy live for just 1 month, you can immediately tell whether your backtest is valid or not. Because the backtest says that practically every day you're going to be profitable, and then you run it for a month and you find that it has a drawdown of 3 weeks. Well, that immediately tells you that your backtest is not completely realistic.
What's your guide for factoring in transaction costs to your backtest? So when I say transaction costs, we're obviously referring to like slippage, commissions, and market impact, that type of thing. How do you factor that into your backtests?
Well, one main source of the transaction cost is the bid-ask spread, and to realistically model that, one need to use high frequency quote data to backtest, and that's explained in one of my blog article also. Why sometimes low frequency strategy backtesting requires high frequency data, because you need the bid-ask spread in order to get the bid and ask quotes to figure out exactly what price you're going to execute at. Just having trade prices doesn't help that kind of transaction cost model. Beyond that, we have to look at the top of book quote size. A lot of this strategy, particularly high frequency strategy, that look very good on paper and particularly favored by academic researcher, you will find that it doesn't work beyond the top of book, and that it assumes that if you are trading just 100 shares, this model indeed is very profitable. But once you intend to execute 1,000 shares or 10,000 shares, this strategy will be completely gone. It will completely fall apart, because when you have to take more than the top of book quotes and lose more money to take the deeper into the book, the backtest will show that it won't work. So that's not only do you need the quote price, but you also need to know the quote size in some of these backtests. And then, not to mention, there are even more problematic issues such as market impact. Once you take the top of book liquidity, how fast the liquidity replenishes itself, or if you put out a limit order there that is a substantial size, is it going to affect the order book? These issues are really in the domain of high frequency trading. Even though you may not be a high frequency trader, but if let's say you're a discretionary trader and you intend to hold for at least a couple of hours this position, but if you put a order into the order book that is much larger than the typical order size, quote size, you are going to affect the order book, and you are going to have incurring opportunity cost. You're going to affect things, and that kind of modeling nowadays being conducted a lot of times by high frequency trading research, and there are a lot of very complicated mathematical models coming out to model that kind of process. But but that's what I'm saying. This is the kind of transaction cost that's much more difficult to deal with. Opportunity cost and the effect on the order book because of your limit order. But I don't claim that we have a grasp on it, but I understand that this is a field of active academic research.
Okay, sure. So let's just do a couple more questions, and then we'll probably start to wind things down. What are some of the common misconceptions people may have around quantitative trading?
Misconceptions. Well.
Okay, so here's an example. Let me ask you this: is quantitative trading just for an elite few who are math wizards, or do you honestly believe it's an angle that can be implemented by anyone willing to put in the work?
I do believe that it is suitable for practically anybody who is willing to at least learn how to use an Excel spreadsheet. I have collaborated with some very successful traders before that indeed have no programming skills except programming a Excel spreadsheet. Not naturally, they are not doing high frequency trading. They are doing trading that enter a position once a day. But that doesn't mean it's not quantitative. Quantitative trading could be a very slow trading. Could be holding a position for 1 quarter or 1 year. That could still be quantitative trading. So one does not need to be a math whiz, and certainly does not need to be a programming computer whiz in order to do quantitative trading. All one needs to do is to be able to gather data and backtest it, no matter what tool you use to backtest. Could be as simple as an Excel spreadsheet.
Okay, so a trader who wants to get started in quantitative trading or really wants to dive deeper into the subject and, give it a real shot, where should they start?
I would suggest that they should start from trying to backtest some of the simplest strategies that they know about or they read about in any sort of trading magazine or blog or books. And there are many of them. I've seen some that are really simple. I've read a lot of trading books where the strategies are extremely simple. Such as sell on the 1st of May and buy the index, at the end of October. That how can it be simpler than that? But that's a start. And or some strategies such as saying that we should always buy when the price drops below the 10-day moving average and sell when it's above the 10-day moving average, something like that. That can be quite readily backtested in an Excel spreadsheet. And once you gain confidence in your backtest method, you might want to next learn a simple trade programming language. I even though I said that yes, it's possible to start as a quantitative trader by using Excel only, but that doesn't mean that's the optimal state of affairs. To improve your ability as a quantitative trader to sort of expand the repertoire of your strategies, one should learn a better programming language than Excel, namely, and I always recommend one of 3 languages: Python, R, and MATLAB. So that's the next step. Once you have some confidence in backtesting using Excel, well, start to learn the programming language so that you can backtest a wider variety of strategies, especially intraday strategies.
Okay, yeah, that's a really great answer, Ernie. And just on the languages there, so you mentioned MATLAB, Python, or R. How do you feel about languages such as TradeStation's Easy language? What's the pros and cons of going in the direction of more of an open source language, even though I know you have to pay for MATLAB to use that, but Python and R are, both open source languages. How do you feel about comparing those to more of a, I don't know, you could probably call it a proprietary language like TradeStation's Easy Language? What are the pros and cons there?
Well, the pro of using a language that a brokerage trading platform provide is that it can be very easily turned into a live trading system. So you can backtest and trade live using exactly the same code and just flip a switch and it will generate real-time orders. So that's very convenient. The problem is that if you want to switch brokerage, all the script that you've written before, of course, doesn't work anymore. If you want to switch to interactive brokers, your easy language will have no use and you have to start from scratch. And another problem with those brokerage languages is that they tend to be rather limiting. They are not designed to encompass. So it's quick, very extreme example. Let's say you want to build a neural network to generate trading signals. I challenge you to do that with easy language. It's just not possible. I don't believe it's possible because if you want to build a neural network from scratch, it will probably take months. And maybe even months won't do it because there will be many bugs unless you're an expert in building machine learning languages. For a MATLAB trader or a Python trader or a R trader, we would not be building a neural network from scratch. We would be using a neural network library that is ready-made in order to generate trading signals. So that shows you the flexibility that is inherent in one of these standard languages. Whereas, if you want to use the same neural network program in easy language, well, you have to wait until TradeStation develop it for easy language, which might be never.
All right, Ernie. Well, thanks for summing that up. Now, you've got 2 published books. One is Quantitative Trading and the second is called Algorithmic Trading. What can readers expect to learn from reading your 2 books here?
Well, I think these 2, the first book particularly answers some of the questions you raised earlier about how to get started in quantitative trading. As let's say you are a discretionary trader, or maybe you never traded before even. Maybe someone is a new graduate or came from a different business. Let's say they are an accountant and wanted to get into trading as a hobby or as a full-time job. Well, the first book is really geared for that type of people. It really starts from the basics. The second book is more of a more focus and perhaps go into some of the trading strategy in more depth. And some of the techniques are also more complicated. Things like Kalman filter, the vector auto regression, vector error correction models, this sort of stuff, or maybe a bit off-putting to a complete novice in trading, but they would be useful to someone who has traded in a systematic manner for a while, but would like to learn newer techniques. So that's what the second book is about. It's really introducing something a bit more detailed and more focused and more complicated to the traders who already have been doing some quantitative trading already.
Okay, yeah, and I mean, both those books are definitely on my list to read, and I hope to get stuck into those very soon. So I'll link to those in the show notes at chatwithtraders.com. Ernie, where can listeners go to find out more about you, and where can they connect with you?
Well, I run a blog, epchen.blogspot.com, and it's open to comments. Anybody can comment on it, and I try to answer them very rapidly to any questions. I have also I have been used to updating the blog with new articles more frequently than now, but now I'm writing a new book, so I don't have much time to update it. So, but despite not having a new article published every month, it doesn't mean that I don't answer the comments that readers might want to post on the blog. So that's certainly a great venue. The other one is that on my website, epchan.com, I listed my email, and a lot of readers are communicate with me just by emailing me. So that's sometimes when a reader asks me questions that are generic, I would direct them to the blog because I like to answer a question so that many people can benefit at the same time. But other times, if they just want to ask for advice on a particular situation that they have, certainly feel free to email me directly. And and then also, of course, I run courses online and off, and some of the people who have read my blog and books would come to these seminars, and we could have a real-time conversation as well.
Excellent. Yeah, well, I'll link to both your blog and your website in the show notes also. I definitely encourage listeners to head on over and check out those links. Really great resources there. And Ernie, you're also on Twitter, I believe.
Oh, yes.
What's your handle?
That's right. In my blog, I oftentimes include my Twitter feed, and I don't tweet very often. I don't want to burden our followers with too many irrelevant information. But I do tweet once in a while when I see some interesting information out there. Feel free to follow.
Okay, and what's your Twitter handle?
ChanEP, ChanEP.
Okay, good one. And you mentioned you've got a new book coming out. When can we expect that?
Well, that should be out. It usually take a year to write a book, and I just started very recently. So, and then it will go through editing and reviewing, and then production and the marketing. So, we probably should see it in the first quarter of 2017.
Very cool. And what's it about? Is it a carry on from your last two?
Yes, the topics will be largely different from before. It will, following the second book, it will go into techniques that I have not discussed before. For example, machine learning techniques. For example, options techniques, trading options, which I have not touched on before, and so forth. So it will be, a bit more advanced techniques than what I've discussed before. And also, however, I will just sort of look back into some of the strategies that I've discussed in the first two books and see how they did, post-mortem in some sense for some of the strategy who died, what caused death. And hopefully we'll find some that didn't die either.
Yeah, that sounds really good, and I'm sure many people are eager to get their hands on that. So, Ernie, thank you very much for doing this. I really appreciate you taking the time. It was a lot of fun speaking with you, and I mean, I sure learned a lot. I'm sure the listeners did too. So, yeah, big thanks for doing this, and let's speak again soon.
Great. I enjoy talking to you too. So, have a good night.
All right, awesome. Thank you, Ernie.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.